Hello, students. Hello, my dear friends. Wish you a very, very happy new year. At this time, may this new year be fulfill every of your dream, whatever you have thought of, whatever you want, you achieve that. But see, whatever you want to achieve that, in addition to blessings, there are a lot of efforts which are required. So, New Year, if you see, it's just a change of a date, but it creates an event so that you can think what's going wrong, what's going right, what was your plan, are you on your plan or not. The planning is very important. There's a quote which says that failing to plan is a planning to fail. So but nothing has lost. You can do whatever you want to do, and if you think that time is less, it's not. Whenever you think that time is less, double your efforts, you know. Ultimately you have to achieve your goal, whatever the goal you have set. So there is no negotiation on that point. You just have to see the cost which is required to achieve your goal. Most of the time, the cost is sleepless nights. So with this, I I start my lecture. You know, just have faith in you, and you can do everything. Everything is possible. There are a lot of people who are working hard, and they will achieve, and so is you. Okay. So today's lecture is a continuation of the my last lecture, NR taxation. Today we will discuss a very important topic. We will discuss section 9 in a little bit time. See, I told you the big four, mostly the big four in the corporate taxation, does 90% of the work is related to international taxation. And out of this 90% work, 70% work revolves only around this section 9. We will do majorly this section 9 only in today's class, nothing more. But if you could understand actually what the section 9 is, you will get a very good hold on international taxation. Today's class will set a base for you for the international taxation so that you could understand. It's generally considered as a very as a very unique and a complex field of taxation, international one. And people generally respect the person who understands this and who knows the international taxation. It's a practice in itself. This section 9 and DTAA led with, it's in a practice in itself. Okay. So let's start with our class. So if you remember, we discussed in the last class about residential status. And we also discussed what is the relevance of residential status. So relevance was, if you are resident, your global income is taxable. So irrespective of the fact wherever the income is received or accrued, it is taxable in the hands of resident. But if you are non-resident, then only your Indian income is taxable. And by Indian income, we meant income which accrue or arise in India, or income which is received in India. Where it is written? It is written in section 5. So do we need to remember section number? No, my dear friends. It's better. You know the section number. It gives you confidence. But never write wrong section number in the exam. Write the section number only if you are 100% confident that the section number is right. Okay. So if I come to my notes, these notes I have already uploaded on the portal. So it says, wait a minute, the scope of total income. We have read this many a time. Just revising. Income received or deemed to be received in India is taxable in the hands of everybody. ROR, RNOR, or NR. Income accrue or rise or deemed to accrue or rise in India, taxable in the hands of all the person, irrespective of the residential status. This income I call Indian income. Income which is accruing or rising in India or received in India. Because it's taxable irrespective of the residential status, whether you are resident or non-resident, it's taxable. Income accrue or rise outside India from a business controlled from a professional setup in India. This is the precise difference between the RNOR and NR. So this is the income which is taxable in the hands of RNOR, but not taxable in the hands of NR. Any other income which accrue or rise outside India is taxable only in the hands of ROR. It's not taxable in the hands of RNOR or NR. But if we talk about the company, then there is no concept of RNOR. This is not applicable in case of companies. In case of company, if you're resident, your global income is taxable, irrespective where it accrues or where it is received. If you're non-resident, your only Indian income is taxable, which is income which accrue or rise in India or income which is received in India. Are you with me? Any doubt? Do let me know if you have any doubt. Let me open the chat box. Happy New Year, Sanjay ji. I always struggle with this chat box. Okay. Next it says, take it for an example. There's a person called seafarer who is a member of a ship or a cruise. So if he's an NR, but he has an account in India and his salary is received, salary from the shipping company, he received in such NR account. Then whether such salary is taxable or not? Tell me. The services are rendered while he was in ship, and ship was in not in Indian territorial water. Ship was outside territorial water. So obviously services are rendered outside India. So they are not accruing or rise in India. We discussed what do you mean by accrue or rise? Means the accrue or rise means the place where the activities are performed to earn such income. Okay. But there is another clause. Received in India. Here the salary is received is in his NRE bank account, which is in India, and therefore it can be taxed as on the basis of received in India. And therefore, CBDT has given a benefit that in such case, those salaries taxable on receipt basis, it will not be taxable. So it says income by way of salary received by non-resident seafarers for service rendered outside India on a foreign going ship and received into NRE bank account maintained with an Indian bank. This is the reason the salary was otherwise taxable. Shall not be included in total income. So this is a benefit. You understand? It was taxable and therefore there was need for a benefit. Yeah? Okay. One more thing. What do you understand by the meaning received? Let's take an example. Let's take an example. There's a Mr. A who is working in US for Microsoft. In my example, everybody is working with Microsoft. Microsoft Teams. Okay. There is Mr. B who is also working in US in Microsoft Teams. Both are Indian citizens, but both are NR. The salary of Mr. A is received in his US bank account, and the moment it is received, he immediately remitted to his Indian bank account. Okay. Mr. B says, why so hustle? Let's be smart. So Mr. B, what he does, he gives his Indian bank account to the Microsoft company. And his salary is directly received in Indian bank account. Now, tell me who is smart, Mr. A or Mr. B? Tell me, Mr. A. Of course, Mr. A. Why? Because in this case, if salary received directly in the bank account of Mr. B in India, then such salary shall be deemed to be received in India. It's not even deemed, it's actually received in India. And so if you're resident, then just shut your eyes, all these income are taxable. If you're non-resident, only then I have to see whether which of these income accrue or rise or received in India, which does not. Yeah. So first I have to decide about the residential status of Mr. Piyush. Only then I can comment upon the income. So let's compute the residential status. So he was there in UK for last 20 years. But during the current previous year, he came here on 12th June 2025. So of course, he's in India for the current previous year 25-26 for more than 182 days, more than 6 months. You know, it's very much apparent. So he's a resident. But the story doesn't stop here. Once he becomes a resident, he's an individual. So I have to see whether he's a ROR or RNOR. Yeah. Life is not so easy. So he was in UK for last 20 years. And for ROR or RNOR, we have to see the residential status or period of stay for the earlier years. He was not there in India in any of the earlier years. So he's, of course, RNOR. This is, we are doing conceptual wise. But once you attempt in the exam, you will write the all the provisions and why the reasoning. Right? This is quite simple. So it's RNOR. Okay, good. Now I know for RNOR, the Indian income is taxable, of course, and the foreign income is taxable only for business control from India, profession set up in India. Other foreign incomes, other income which are or arising outside India, not taxable. Okay, you are with me? I am with you. Income, now we can see the income and decide whether it's taxable or not. Income of rent of a flat in London which was deposited in bank there. So he is receiving a rental income from a flat which was there in London, which is there in London. The flat was given on rent by him after his return to India since July 2025. The flat is in London. The income is received in London only. So neither the income accrue here means India, nor the income is received here in India. And is an RNOR. And therefore, this income is not taxable. The fact that he had given the flat on rent while he was in India is irrelevant. I just have to, I will not make my life difficult. I just have to see the two things, whether income accruing or rising or is it received. If it's accruing or rising in India or received in India, it's taxable. If nothing of these two things are happening in India, then it's not taxable in the hands of RNO. Very simple. Okay. In this case, flat is in London, therefore not accruing or rising. Received in London, therefore not received. If you remember, precisely because of this type of people, because of Mr. Piyush, people similar to Mr. Piyush, the concept of RNOR was introduced. Because government want them to come and settle, and for 2 years, government will not tax their foreign income, foreign passive income. So, like in this case, this rental income is a foreign passive income. It will not be taxed till the time he remains RNOR. It will be taxed only when he becomes ROR, which generally takes 2 years. Not taxable. Perfect, Mr. Sanjay. Dividend on shares of 3 German companies which are being collected in a bank account in London. He proposed to keep the dividend on shares in London with the permission of RBI. Okay. In each of these questions, it seems the second line is irrelevant. So second income is dividend income, which is received from the German company. Therefore, the company is German. Therefore, this dividend income does not accrue here. It's collected in London bank account, not received, and therefore not taxable. Perfect. He has got 2 sons, one of whom is of 12 years and other 19 years. Okay, good. Both his sons are staying in London and not returning to India with him. Okay, no problem. Each of his sons is having income of 75,000 in UK in foreign currency, not received in India, and of 20,000 in India. Okay, so he has 2 sons. One is minor, 12-year-old, and one is major, 19-year-old. And both of these sons have each of them have income of 75,000 in UK and 20,000 in India. So, can you answer this? He's asking something about clubbing. So the income which the major son is driving, 20,000 will be clubbed and deduction available. Perfect. So the income, this was the answer by Mr. Sanjay. Good. So the income which the major son is driving is not to be clubbed, shall be taxable in the hands of major son only, depending upon his residential status. I have no, this is not a question present. But the income which my minor son, the minor son of Piyush is driving, has to be clubbed with the income of parent whose income is higher. Okay. Mr. The minor son is driving two types of income. One income is in UK, another one is in India. So the income which is derived in UK is neither accrualized in India or not received in India, so it shall not be clubbed. But the income which is derived in India shall be clubbed with the income of Piyush, assuming his income is higher than his wife. Okay. And if a clubbing of minor income is done, you know there's an exemption of 1,500 rupees if you follow the old tax regime. And the question says he has exercised the option of shifting out of default tax regime. Therefore, he is following old tax regime, and therefore he shall be eligible for 1,500 exemption. And therefore, the income shall be clubbed only 18,500. See, where the students lose marks here, when they don't mention this 1,500. If you see at first instance, you will feel if the question is asking about taxability, whether the income is taxable or not, then why he has given this information that he has shifted out of the default tax regime? This information is precisely, mainly, primarily required to compute the tax liability. But whether income is taxable or not, who are non-resident, this information is not much of important. But you understand why it has given? Now, if you miss this part, even if you have written a correct answer that the income of 20,000 shall be clubbed, but you will not get the full marks because ICAI would be expecting the complete answer. Last income is during the preceding accounting year when he was a non-resident, he had sold 1,000 shares which were acquired by him in British pound sterling and the sale proceeds were repatriated. So in last year, earlier year, he had sold some shares. Okay, what should I do? And whatever the amount he received, he had repatriated to India. Good one. The profit in terms of British pound sterling on sale of these 1,000 shares was 175% of the cost at 37,500. While in terms of Indian rupee, it was 50,000. Okay. So he earned some profit. And now the question is whether this profit is taxable in India or not. See, one thing is, I'm not sure, but it seems that the shares are UK based as for the UK company because the share was purchased. But this is not even relevant. This income pertains to my last year. I am making the computation for the current year. Whatever happened in last year is not relevant. My income tax is a yearly concept. I have to see 1 year at a time. So for this current year, this income even is not relevant. So if you see the total income of Mr. Piyush for this current year in India is only 18,500 from the clubbing. All other income is not taxable and therefore no tax liability in India. And Piyush is very happy. Only income includable under section 64(1)(a) would form part of total income Mr. Piyush. Since total income is only 18,500, there would be no liability to income tax. Okay. Question 2. In these type of questions, this is a module question, so I have included it for the completeness. But if you see, we have done all this type of question in the IPCC. These are IPCC level questions where the question gives income and share and it asks to compute the total income for if the assessee is resident, ordinary resident, RNO or NR. You can do this in your homework. It's very, very simple. I have included this only for the completeness perspective. I have given the answer as well. But if you have any doubt, do let me know in the next class. Okay. Should we move on to our next concept? Section 7. Again, not much relevant from your exam point of view. See, if you see section 5, it says the income is taxable in the hands of all the persons, irrespective of the residency. Is the income accrue or rise in India or received in India? Not this. It has extended. What? It says income received or deemed to be received in India. Income accrue or deemed to accrue or arise in India. So, not only the actual receipt, even the deeming receipt is also taxable. Not only the actual accrual, even a deemed accrual of income is also taxable. What do you mean by deemed? What is this word, deemed? This is a very favorite word of the lawmaker. It uses it very frequently. See, for deem means the lawmaker gives a meaning to a word. And this is the meaning for the, you have to accept it. This is what deem. But it doesn't mean that such meaning was not which you considered as a layman. It may be that you also consider the word has this meaning only. But even if you do not consider, then consider it now. In Hindi we say, mano ya na mano, manna padega. Whether you considered it, the word as such, the meaning which is given, you also feel that the word has this meaning only, then very good. If you don't feel, then now you have to take that meaning as for this word. Okay. So whether you feel that this income is actually received in India, very good. If you feel that no, this is not the actual receipt, this is not the receipt, you can't say it receipt. Well, forget it. I am saying it receipt. I mean, lawmaker is saying it receipt. You have to consider it as a receipt. Okay. So whether you consider it as a receipt or not, now you have to consider it as a receipt. So these three incomes are core salary income, which we have studied in IPCC. It's not even your part of your syllabus in the final. So it says that if the interest on RPF is exceeding 9.5%, or the contribution exceed 12%, or you have transferred money from URPF to RPF, then these income are taxable in the hands of an employee under that salaries. Okay. Now we are moving to the most important topic of our chapter, section 9. This is the base of international taxation, as I told you. What it says, income deemed to accrue or rise in India. What do you mean by income accruing or rising in India? Income accruing or rising in India means the income in respect of which the activities are performed in India. This is what we understand by the meaning of actual accrual. But section 9 gives a list of incomes, which it says the list may contain some income which you also feel that is accruing or rising in India. Very good. But the list may contain some income which you feel no, it's not accruing or rising in India. You can't say it's accruing or rising in India. The activity for earning this income is not happening in India. So this income should not be said as accruing or rising in India. No, full stop. If the lawmaker says he will deem it accruing or rising in India, then you have to consider it accruing or rising in India. What is the implication of this provision, section? Once an income is deemed to accrue or rise in India, then it shall be taxable in India, irrespective of your residential status. Whether you're resident or non-resident, it shall be taxable. One more thing. Tell me, this section 9 is important for whom? For a resident or for a non-resident? Anybody? Please, fast. Who will study this section 9? An R or an NR? NR. Perfect. Why? Give me the reason. Why not R? I tell you. Because if you are an R, and I know you know, it takes time to write. If it's an R, then whether the income accrue or arise, whether you deem it to accrue or arise in India is irrelevant. My global income is taxable. Whether it accrues in India or outside India, I have to pay tax in India on that income because I'm resident. But if I'm an NR, a non-resident, then if you deem some income to accrue or rise in India, then I have to pay tax on such income. Okay. So an NR always wants the list to be concise. to be limited, because all this income which is there in section 9 is taxable in the hands of NR. You know, the government wants this list to be expanded. So we will, good, Sanjay ji. So we will study this section 9, keeping in mind at NR, from NR perspective. Only then you will actually appreciate the provisions. If you read it from our perspective, you will not be appreciate the provision. So, first thing, base, you will read section 9, all the incomes referred to in section 9, as such income are being received by NR. You will read, we will understand this, we will discuss this as if the assessee is non-resident. You understand why? Okay. So, first income is all income accruing or arising whether directly or indirectly through or from any business connection in India shall be deemed to accrue or arise in India. So it says if there is an income which is accruing or arising from business connection, this income is accruing or arising to whom? To NR. Of course, we discussed this. So if this income is accruing, if the NR is receiving an income which is arising from business connection in India, then such income shall be deemed to accrue or arise in India and therefore taxable in India. I am with you? Any doubt? No. Of course, a lot of doubt. The word business connection, what does it mean? See, what do we understand by the term accrue or arise? It means activities are performed in India. So, assuming there is a business which has a manufacturing facility in India, sales are in India, R&D, research and development unit is in India. The entire business is in India. Whether the income from such business is taxable? Of course, taxable. Everything is happening in India. This is the actual accrual. I don't need a deeming fiction, right? But there is no doubt about it. Okay, we are very much clear. What if only a part of a composite business, a part of business activity is performed in India? Activity is undertaken in India. I give you an example. Take an example of Apple. The Apple iPhone. Okay, the most cashless company of the world, Apple. So, we know Apple has a manufacturing facility in India. I hope you know manufacturing facility in India. And China is not happy about it. So is Mr. Trump. But that's not relevant for our discussion. So, Apple has a manufacturing facility in India, but assuming the entire R&D is outside India, then the raw material are purchased outside India and sales are made outside India. Now the question comes, the profit which the Apple is making from these sales, can it be taxed in India? Tell me. Apple is no doubt an NR. The foreign company has no poem in India, therefore is an NR. It can be taxed in India only in two situations where one, the income accrue or arise in India, or income is received in India. If we can conclude that neither the income accrue or arise nor received, then Apple cannot be taxed. Can we say that income is received in India? Of course not. I told you, factually the sales are happening outside India. The income is not received in India. Can we say the income is accruing or rising in India? For this, I have to see where the activities are being performed. But a business is a lot of activities. Only a part of it, only a manufacturing activity is being performed in India. So can I say that my business is being undertaken in India? No, only a part of it is happening. And this part is known as business connection. So what the law says, if you have business connection in India, if you're doing some activity related to your business in India, then the income from such business connection is taxable in India. I will deem to that you have that such income accrue or rise in India. I will deem it. Otherwise, there could be a litigation whether the Apple would say most of my activities are outside India. So predominantly my business outside India, I'm not accruing or rising in India. But now the law says if you have a business connection, and what do you mean by business connection? Even a part of activity is carried out in India of such business, then the income from such business deemed to accrue or rise in India taxable. Now the question comes: will if there is a business connection of Apple in India, will the entire profit which the Apple makes from this sale is taxable in India? Logically, the answer should be no, because only a part of this profit should be taxable. Which part? The part which is attributable to the operation carried out in India, manufacturing facility. Okay. But somebody may argue, no, the income arises only from the activity of sales. And sales are happening in India, therefore, nothing should be attributable to manufacturing. But if you go a little deep, you will see the fallacy in this argument. This sales happens is the result of all the activities which has happened before it. So the profit, whatever you have earned, say rupees 10 rupees from the sale of this product, this 10 rupees is attributable to all these activities. How much is attributable? That is a separate question. But first, something is attributable to the manufacturing activity as well, which is happening in India. So what the law says, if there is a business connection, but all the operations of business are not carried out in India, then the income which shall be deemed to accrue or rise in India shall be only such part which is attributable to the operation carried out in India. Clear? Any doubt? So what it says, in case of business of which all the operations are not carried out in India, the income attributed to operation carried out in India shall be deemed to accrue or arise in India. So Apple, the entire sales will not be taxable in India. Only such percentage of sales which is attributable to manufacturing facility shall be taxable. Now, how will you determine what is the amount which is attributed to manufacturing facility? So we apply transfer pricing principles to determine the attribution. Okay. I think at final level, it's not a part of, in a very detailed manner, part of its level, this attribution, though you will study transfer pricing and how to compute the arm's length. So once you study, you can relate it, you can apply this here also. So what happens is that you look for the companies which are only manufacturing and selling to third parties. So whatever profit they are making for the manufacturing operation, a similar margin we shall keep for the manufacturing facility of Apple. Clear? Good handout. See that if you practice in taxation or international taxation, these terms, business connection, permanent establishment, royalty, FTS, you will deal with this regularly, very, very frequently. And let me tell you, even most of the big four employees are not very much clear about this. So it's very important that you do your basics very strong. So don't feel whatever you're doing day and night, you should be very comfortable with that. You should not be uncomfortable or feel weak in such concepts. If you do the international taxation practice, these terms, these concepts will live with you. Okay. So, what the business connection means? Why business connection exists? For us earning income from India without presence, India wanted fair share of tax, link between income and India required. This is actually the basis why the tax exists. Why the tax exists? Because the government says if you're using my resources, my government resources, then you must pay a portion of it to me as well. So if a foreigner is earning income, is using the resources, is generating income by using my resources, the resources of India, then the Indian government also has a share. What is the meaning of business connection? See, the word business connection is not actually defined in the Act. But now you understand what it means? There should be a real and intimate relation between the business and India, the Indian soil. Something must be happening on the Indian soil to constitute a business connection. One of a transaction cannot constitute a business connection. There should be a continuity. We have to see actual substance, then the form. Foreign company sells goods in India, operation partly in India. Income attributable to India, taxable. Simple. Apple example. Okay. Very important concept. Business connection means the business connection should be in India. You see, the word is written all income accruing or arising through or from any business connection in India. The word in is very important. I should be doing business in India. There's a difference between the word business in India and business with India. When I export goods from outside India, see, there's a Apple. It exports goods to India. And there's an Indian person who buys Apple from outside of India, say from Dubai. Can we say that the income which the Apple has earned from this sale is attributable to in India? No. Because what the Apple has done, it has only done a business with India. It has not done any activity in India. The R&D was happened outside India. The goods were manufactured outside India. Sales happened outside India. Contract was signed outside India. The money is received outside India. Everything happens outside India. Only the buyer is in India. So it's called business with India. He's doing business with India. He's not doing business in India. He's not doing any activity in the Indian soil while in the Indian soil. Clear? So this business in India is the business connection. Business with India is no business connection. It's nothing taxable. Unless there's some activity in India, business connection does not exist. You with me? Examples of business connection. Branch or office in India. You are actually doing activity in India. Factory or a workshop. You have a factory. You have a sales outlet. All these activities are happening in India. And therefore, the income attributable to these activities shall be taxable in India. Not the entire active income. Only the income attributable to these activities. The intent is all this term gets into your mind, you absorb it. Okay? Tell me one thing. We understood what is a business connection. Now, what the foreigner, what the Apple, what the non-resident would want? He would want to have a business connection in India, or he would want that his activity doesn't constitute a business connection. Of course, he would want that his activity do not constitute business connection. If it does not constitute business connection, then there will not be any indemnification and the income shall not be taxable in India. Very logical. Okay. But so had you been an Apple or had you been an NR, what would have you done? Instead, what would I have been done? Instead of me physically present, see, I have a branch office, I have a factory, I have a sales house. Instead of me having a physically present in India, what I'll do, I'll appoint an agent who will do all these activities on my behalf. Instead of me setting up a factory in India, what I'll do, I give this contract to an Indian company and say, manufacture the Apple iPhones as per my requirement and sell to me. Okay. So instead of me doing the sales in India, I am sending my employees doing the sales, soliciting the clients. What I'll do, I'll appoint an agent who will do all this function for me. And I will say, I am not present in India. Business connection will happen if the assessee is present in India. I am not present in India. These are agents, he's a third person, and he's doing his own activities. But if Apple is selling in India, it will anyway be taxable in India due to income accrued or received in India. Okay. Just I'll answer this question in a minute. So and I'll say, I am not present in India. These are agent person, third person who is doing this activity. Okay. But of course, this is not acceptable. He's doing all these activity on your behalf. So, means actually you. It represents you being in India. And therefore, law says, even if you're not present, as you is not present, if there is some agent who's acting on your behalf, it will be deemed that you're doing such activities and business connection shall constitute even with the presence of agent. Okay, we'll discuss in a minute. Okay, Sanjay is asking if Apple is selling in India, it would anyway be taxable in India due to income accrued or received in India. See, there are a lot of assumptions in your question. One, you said income is received in India. It depends whether the sale proceeds directly being remitted to the US bank account of Apple or Indian bank account. If it's remitted to Indian bank account, it's of course received in India, taxable in India. Or if directly remitted to the foreign bank account, it's not received in India. Second, more importantly, we are saying Apple is selling in India. So by the means selling in India, you have to see what activities the Apple is doing for this sale. If Apple is only exporting goods into India, it's for business with India. It's not doing any activity. The Indian customer is placing an order outside India and he's just exporting the goods. Okay? But if it has a sales outlet in India, it has a shop in India, from this phones are being sold, then we can say that selling is happening in India. Whatever the income attributable to this sales outlet should be taxable in India. Okay? So what the law says, whether you are yourself present in India, business transaction will happen, or there's some other person called agent which is acting on your behalf, then also business connections shall constitute. So in case of agency, it says three types of agency, three categories. If your agent is doing any of these work, then it will be deemed that you have business connection in India. The business connection shall include any business activity carried out through a person who acting on behalf of non-resident. So acting on behalf of non-resident means agent. Activities are carried out by agent, not by the non-resident. But still, business connection of non-resident shall constitute. What are these activities? They are basically three activities, A, B, C. The A, the agent, what the agent does? He has and habitually exercises two things. He has what he has. He has an authority to conclude contract on behalf of non-resident. Non-resident is selling some goods, so he has an authority to conclude the contract of sale, and also he habitually exercises such authority to conclude the contract on behalf of non-resident. So what I'll say, it's a very important function. It's doing a sales on your behalf. So whatever his activities, the profit attributable to these activities shall be taxable in India. But he should have such authority and he should habitually exercise such authority. The word habitually means on a continuity basis, not one of a transaction. Okay? Understood? This was the law for a long time. But now what the foreign people used to do, they have an agent in India. He's doing everything. He's going to the customer office, showing the catalog of your product, of the product of non-resident, even negotiating the prices, finalizing the prices. But at the end, what he says, no, I don't have the authority to sign. I can't finalize the deal. The deal shall be finalized by my foreign partner. You have to send a mail and he will only approve, then only I can sell, then only the sale would be completed. But if you see historically, whatever the price the agent has agreed is never rejected or refused by the non-resident. All the contracts, all the deals which the agent has proposed has been accepted on as is basis by the non-resident. So what does it show? Does it show that agent doesn't have authority to conclude contract? He actually has an authority. It's only on paper. Formally, the authority is kept with the non-resident. But if the non-resident always agree to whatever the agent has promised, then who is the de facto authority? Is the agent. So, but why it happens? It happens to escape this point. to say that my agent doesn't have an authority to contract, and therefore his activity will not constitute business connection, and therefore nothing is taxable. But no. This is not right. You are playing with the words. The non-resident playing with the words. You're with me? So, amendment made, I think, in 2018, and it says the business connection shall include the activity of agent who habitually concludes contract. He may not have such authority formally, but he habitually conclude contract, or importantly, habitually plays a principal role leading to conclusion of contract by that non-resident. So, even if the contract is concluded by the non-resident, but this agent is playing the principal role in such conclusion, even then it will be deemed that the non-resident has a business connection in India. You understood? Till 2018, the law was only up to this, that agent should have an authority and he should habitually exercise such authority. So what the non-resident foreign company were doing, they drafting their agreement in such a way that a formal approval is only with the non-resident. The actual deal is sealed only with the approval of non-resident. And they argue before the court that my agent has no authority to conclude contract. And I'm showing my agreement with the agent. He has no authority to conclude contract, and therefore I'm not falling under this clause. I hope you're following me. Yeah, this is very important. So, to overrule such arguments, amendment was made. It says, okay, I agree. The agent doesn't have an authority to conclude contract, but that's not even required. I changed the law. What is required? If even if your agent plays an important role, principal role, then also I would say you have a business connection in India. You miss the non-resident. Okay. Now you cannot say that the agent is not have a principal role. He's going there, he's showing the catalog, doing negotiation, everything. So he has a principal role in conclusion of contract, and therefore, whatever activity he's doing shall constitute the business connection of non-resident in India. He habitually plays a principal role leading to conclusion of contract by that non-resident, and contracts are in the name of the non-resident, of course, because actually the contract is in the name of non-resident. Contracts are for the transfer of ownership or for granting of right to use property owned by that non-resident, or that non-resident has a right to use, or for provision of service by that non-resident. In a sense, this 3 points say, irrespective of the nature of the contract, whether they are for the sale of goods or for giving the right to use, or whatever right you're giving, even if the non-resident doesn't have that right, he has also taken such right on use from some other person, or the contract is for provision of service by that non-resident, irrespective of the nature of contract. If your agent in India is playing a principal role, then whatever income you derive from such contract, a part of it shall be attributable to India. You with me? One more thing. We are saying many a time business connection. Does the business connection includes the profession as well? So yes, the answer is yes. Business connection includes professional connection as well. So whether you're selling a goods or you're rendering a professional service, if there is an agent in India who is helping you in concluding a contract, then the income from such service, a part of it shall be attributable to Indian operations. But the second thing which the agent may do, it's not all the things that he should do to qualify business connection. Even if he does a single thing, either A, B, or C, a business connection shall be constituted. Second thing is, the agent has no such authority, to conclude contract, okay? But he habitually maintains in India stock of goods or merchandise from which he regularly delivers goods or merchandise on behalf of non-resident. What is happening? A non-resident is maintaining a stock of his goods in India. And who is maintaining that? Agent is maintaining that on behalf of non-resident. Then it will be deemed only this fact that you have a goods in India from which you supply it to the Indian customer. Only this fact, standalone this fact, constitutes your business presence in business connection in India, and a part of income from the such sale is attributable to India. If there is a stock, if there is some person who is maintaining a stock on your behalf and delivering the goods from the stock to your Indian customers, then shall be deemed that you have a business connection in India. Okay. The third and the most important, habitually secure order in India. What do you mean by secure order? It means soliciting clients. So he's actually doing advertising for you, he's soliciting clients for you, and he secures order for you. Even if the contract is not concluded by him, but he's helping you in securing order in India. Then he has a factory in India. Of course, he has a business connection in India. No doubt. Clear? I said, no worries. Even if you have an agent in India who is acting on your behalf, then also you have a business connection in India. Then I would say that this agent represents the NR only. And it will be deemed that NR is actually doing this activity in India. But the agent is working for many NRs, different, not connected. Then the agent is independent and his activity will not constitute business connection. Okay. So what people do, they say, he is Mr. A, he is securing order for NR1. Okay. But now if he secure order only for NR1, then he would qualify the dependent agent and NR1 would have a business connection in India. So what he does, NR1 has a subsidiary, NR2. So this agent also provides service to NR2. Now the NR may argue that he is not providing service only to me, he is providing service to two different NR. The subsidiary is a separate legal entity and therefore is an independent. But in substance, we understand it's just try to escape the tax. It's not the intent which the law wants. What the law says, even if this agent is providing service to the NR or to the NR and to his subsidiary or to the NR and his holding or to the NR and his fellow subsidiary. So, assuming there is a holding company, there is NR, my SSC, there is another fellow subsidiary of this NR, FS, there is subsidiary company of this NR. Okay. If the agent is providing service to this NR and this subsidiary, then also he will deem as a dependent. This NR and his holding deemed as dependent. This NR and his fellow subsidiary deemed as dependent. So within the group is happening, I will deem that he is dependent. Now see, the agent habitually secures order in India mainly or wholly for the NR or for that NR and other NR controlling that NR. Matlab, the other NR is controlling that NR means the SSC. So I am talking about holding and this SSC. Or the other NR is controlled by that NR. I am talking about the SSC and his subsidiary. All the other NR is subject to same common control of the SSC. So I'm talking about the SSC and his fellow subsidiary. So irrespective of this, I will deem you are a dependent agent. See, this concept again written. Business connection shall not include any business activity carried out through a broker, general commission agent, or any other agent having an independent status if such person is acting in the ordinary course of his business, where such person works mainly or wholly on behalf of a non-resident principal or on behalf of such principal and other NRs. Who are the other NRs? Which we studied only. Which are controlled by the principal, subsidiary, have a controlling interest in the principal, holding, or are subject to same common control, fellow subsidiary, as a principal. He shall not be deemed to be a broker, general commission agent, or an agent of an independent status. So, if you are providing service only within the and different entities in a group, then we will not deem you have an independent status. You cannot say I'm providing service to many NRs and therefore I'm not a dependent. What dependent means actually, if the agent is economically and legally dependent on the non-resident, then we say that he is a dependent agent. Economically means most of the contracts, most of its revenue is coming from a single person, and legally, maybe he's a subsidiary of that person, something like this. Okay. So this concept, so what we studied till now, we study what is a business connection. It started with the presence of physical presence of non-residents. But then the law evolves and it includes even if the activity are performed by agent, it will constitute a business connection. But the requirement was that agent should conclude contract. But then law again evolved and the definition was expanded to say even if agent is not concluding contract, but if he is playing a principal role, then also we will say that the NR has a business connection. You're seeing how the law is evolving depending upon the circumstances. As the business evolved, the tax law also evolved. Okay. So let's see this agency business connection. Why agency concept was introduced? A foreigner may not come to India personally, but may still do business in India through another person. The other person is called an agent. We are doing this in depth so that you actually absorb the concept. So the law says if a non-resident carries on business in India through an agent, then the non-resident treated as having a business connection in India. So whether you do yourself or you do through an agent, I will treat you as having a business connection in India. The law initially assumed business done personally or through office, branch, or factory. But in reality, businesses often operate through representatives, which we call agents, especially foreign companies. Once the law evolved to say if someone in India habitually acts for you, it is as good as you being here. Clear? Say, Mr. John lives in the UK, he sells industrial machinery in India. He sells it, he producing machinery, some industrial machinery. He sells it in India. He never comes to India. But Mr. Raj in Mumbai finds customers, negotiate price, finalize orders, collects payments. Can we say that Mr. John have no connection with India? Tell me. Can we say that Mr. John has no connection with India? Because he is not coming to India for even a once. But, of course, right, Mr. Sanjay. But he has a representative who does everything on his behalf. So, to cover this, the business connection definition was expanded to include agent. Answer is no. Mr. Raj is effectively John's India business mom. This is business connection through agent. Who is an agent? Agent is a person who acts on your behalf. Is a person who acts on behalf of non-resident, helps him earn income from India. Law identifies three types of agent-based business connection. One, who is concluding contract or playing a principal role. Second, who is maintaining a stock. And third, who is securing an order. Category 1, who habitually concludes contract. If a person in India habitually concludes contract or habitually negotiate and finalize the contract on behalf of non-residents, business connection exists. Agent who habitually concludes contracts. Say foreign equipment supplier, foreign company supplies heavy machine. Indian agent does everything, negotiate the price, finalize the terms, and customer only signs formality later. He gives the assurance that the contract is finalized. On the signing is the formality part which happens later. Contract is signed abroad. No worries. Substance or from contracts actually concluded in India. If all commercial decisions are taken in India, mere signing is irrelevant. Second category is if you're maintaining stocks. If a person in India maintains stock of goods for non-resident, he deliver good to customer in India on behalf of non-resident, business connection exists. So you will remember it. Three types of business connections through agency. One, if you conclude contract or you play a principal role in concluding contract. Second, you maintain a stock. And third, you secure orders. If your goods are waiting in India to be sold, your business is ordered in India. Agent who habitually secures orders. If a person in India regularly finds customer, secure order mainly or wholly for the non-resident. Even if final approval is abroad, business connection exists. Securing order is itself sufficient to constitute a business connection. Indian agent travel across India. So there is a person who travel across India to the prospective customers, get purchase order, sends them to foreign principal. Principal almost never rejects the order. Reality, Indian agent is a real sales engine. If rejection is only theoretical and not practical, orders are effectively secured in India. This PPT, these examples, this repetition is only to clear the doubt in your mind so that you actually understand the concept. It's actually, I'm trying to simplify the concept to the extent I can. It's actually a complex concept. There are books written only on the term business connection. The entire book is written only interpreting the term business connection. You will see there are case laws starting from 1922 Act, where the courts are writing 50, 60, 100 pages of judgments to define, to ascertain whether the activity constitutes business connection in India or not. Dependent agent. Why important? Because only this dependent agent constitutes business connection. An agent dependent if he works mainly or exclusively for one non-resident, or such non-resident and he's holding his subsidiary or his fellow subsidiary. Acts under detailed instructions, has no real independence, bear no business risk. Independent agent means an agent independent if he works for multiple principals, has own business setup, bears entrepreneur risk, is legally and economically independent. Taking for example, Jirodha. Jirodha lender gives service to many customers. He is independent. Take an example, you do a known of you person, a known person of you feels that he is very specialized in share market and he started his portfolio management service. But since he is new, his only client is you. Then we cannot say that he is dependent. Though he wants service, but it's economically dependent on you. So with exclusive broker, likely dependent, stock broker, usually independent. This is just an example. So business connection means you may sit abroad, but if someone in India is regularly doing your business work, the law will treat you as doing business in India. So earlier definition was he has to conclude contract. But the foreign company starts drafting smartly, same business. What they say that Indian agent does everything. He meets customer, he negotiates price, finalizes specification. But the contract says final approval shall be given by the foreign head office. And because of this line, the foreign company used to argue before court that he is not concluding contract and therefore no business connection. Though in this case, he could very well be fall under the concept of securing order. But see, I tell you, even in case of securing order, the business connection exists. What's the difference? Difference is the attribution. Concluding contract is a more important and more important act for a company than securing order. And the more the act is important, more the profits are attributable to India. So we are saying he's securing order, business connection exists, but the profit should be attributable as if he's actually concluding contract. This is the argument of tax department. Because in reality, approval is automatic, no order is ever rejected. Earlier defense by non-resident, agent does not conclude contract. But court struggle, habitually conclude contract was the word which was there in the provision, and therefore court used to struggle whether they should give the benefit or not. Now the amendment came, amended word, business connection now exists if agent habitually plays the principal role leading to conclusion of contract. even if contracts are formally concluded abroad. Then also, business connection constitutes this single difference makes a lot of difference. Principal role means he does all the real commercial work and the foreign company is only rubber stamp. Then the Indian partner is playing the principal role. Habitually, we discuss means not one of a transaction, continuity. One of our activity does not create business connection. Regular systematic involvement does. We have understood dependent agent. So, in substance, do not look who signs the paper. Look who actually runs the deal. Understood the meaning of business? This was a part of it all. What happens now? See, this definition was relevant when you need actually somebody, some person to make your sales in India. What used to happen, say, HP is a company which manufactures printers, right? Now it wants to sell printer in India. So what the government feels, if any foreign company wants to sell its products in India, it has to have some person in India. Otherwise, sale is not possible because there should be some person who sold the product, who is there for after sale service. Indian people need a face so that they can buy the product. Such face may be of the company itself or maybe of its agent. In both these cases, business connection exists and therefore government was getting their revenue. No problem. Yes, in GST it is required. Okay. But what happened recently, not recently in the last 1 or 2 decades, the way the business operates has changed dramatically. Now, HP doesn't need a physical presence in India, neither itself nor for his agent. He can display the product online. Okay. And he can provide the service through his customer care sitting outside. So the way the business are being happening nowadays has changed from brick to click. Earlier, there has to be some office brick, but now we only need a click of mouse to purchase a good. So now, look at the circumstance. HP is selling from outside India. He has no office, no sales outlet, nothing in India, nor any physical person is actually acting on behalf of HP in India. But HP is selling to a lot of Indian customers. Is driving a lot of revenue from India. So, Indian government wants its share. But HP will not constitute business connection. Because for business connection, somebody has to be physically present. Business connection means physical presence. And HP is only virtually present. It is not physically present. Everything is now virtual. See, you're taking this class virtually. Earlier, 10 years back, we could not even think of this thing. When we were doing a CA, we used to go to the classrooms to attend the classes, physically go to the classroom. But now the technology has changed everything. You might be sitting wherever in India and you have the facility to take this class, thanks to YouTube. This is happening every different types of businesses. So by this, the Indian government and the government of all other countries were losing a lot of tax revenues. So to cover that, what they brought in the concept, they widen the concept of business connection and they include significant economic presence within the meaning of business connection. So what they said is that if the NR has significant economic presence, we will go in deep, we will understand what this means. You feel, you for the time being understand that it means virtual presence. Then also it shall be deemed that a foreign resident has a non-resident has a business connection in India. Even if you neither are physically present, nor there's anybody, any of your agent or representative who is representing you. Still, if you're doing everything from outside India, but you're doing something in India from outside India, then I will deem that you have a significant economic presence in India and there's a business connection in India. Okay. So, what the law says, you're observing how the law is evolving with the way the business is evolving. Earlier, it used to happen only business connection when the NR is himself physically present. But then the NR starting appointing their agent to act on their behalf. Then the law evolved to say even the presence of agent shall be deemed as a presence of NR and therefore NR shall be deemed to have a business connection. But now, with the help of technology, the NR does not even need a agent. He's doing everything with the help of technology. Now the law has expanded again and it says that even the virtual presence of NR shall be deemed to be a business presence in India. Let's see how it is written. So this is important to understand how the law is evolving. This gives you a very good conceptual knowledge. Significant economic presence of non-resident in India shall also constitute business connection in India and significant economic presence SCP for this purpose shall mean. So what this significant economic presence means? It means a transaction in respect of any good or service or property carried out by a non-resident in India, including provision of download of data or software in India, if the aggregate of payment arising from such transaction during the previous year exceeds rupees 2 crore. If you are making sales in India and earning a revenue of more than 2 crore, then you have a significant economic presence in India and I will treat you as having a business connection in India. That sale may be arising from download of data or software. So if you're selling a software to Indian customers and the receipts you're getting in from India, aggregated receipt for a year, exceeds 2 crore, then you have a business connection in India. It may happen that you may not get a receipt up to 2 crore, but you are engaging a lot of Indian users. So, SCP shall mean systematic continuous soliciting of business activity or engaging in interaction with such number of users as may prescribe. And the number of users prescribed is 3 lakh in India through digital means. So, if you're engaging at least 3 lakh number of users in India in a previous year, even if you're getting a revenue of less than 2 crore, not getting any revenue, but if you're engaging, you're interacting with 3 lakh people in a year in India, then it will be deemed that you have a significant economic presence in India and therefore you have a business connection in India. You getting my point? So what we have studied till now, let's revise for a moment. We studied that Section 9 says income deemed to accrue or rise in India. Income deemed to accrue from where? If the non-resident has business connection in India. What do you mean a business connection? If any part of its business or profession activities performed in India, whether by himself or through agent. If the agent does any of these 3 activities, it will be deemed that non-resident has a business connection in India. What is meant by interaction with users? I'll come in a little bit. So, what types of activity with the agent it does? He either habitually conclude contract or principal plays a role in concluding contract. He maintains stocks on behalf of non-resident, stock of goods. He secures order. But the agent should be dependent, should not be independent. Okay? Yes, from Sanjay ji. He's asking what is meant by interaction with user. See, these concepts are quite new. They have not touched the judiciary. The word interaction with user generally means you're trying to sell your goods to the user. You're engaging the user. But it's not very much clear how the revenue will interpret it. I'll tell you. I'll give you some examples. The Indian people are making a lot of reels on YouTube. Okay? So the YouTube, the foreign company, is actually engaging a lot of people in India. So somebody may argue that you're interacting with the Indian user, which exceeds 3 lakh in a year, and therefore, whatever revenue you are driving, because the YouTube drives ad revenue from these reels, Whatever you are driving, a part of it should be attributable to it. Understanding? I give you another example. There is an e-commerce platform where the Indian customers are also selling. Indian people are also selling. So, and buying. So the platform is in US, is outside India. The server is outside India. But that platform is engaging with more than 3 lakh people in India. Then it can be deemed that he has a significant economic presence in India and therefore business connection needed. Okay. The transaction or activities shall constitute significant economic presence in India, whether or not the agreement of such transaction activities entered in India. Non-resident has a residence or place of business in India. Non-resident render service in India. Of course, it says that all these three activities is not relevant. If these two clause, any of these two clause is satisfied, then the non-resident shall be deemed to have a business connection in India. What are these activities? Whether he's actually has a place of business or residence in India, of course he doesn't have. The agreement is entered in India. Of course, it will not be entered in India. It will enter outside India. The non-resident render service in India. The service will be rendered from outside India. Had the service been rendered in India, it would have become actual business connection, actual accrual of income. Further, where business connection established by reason of significant economic presence in India, only so much of the income as is attributable to transaction referred to in A or B above, this A and B, shall be deemed to accrue or arise in India. So clarificatory, of course, if only a part of activities performed in India, the income attributable to such part is only taxable in India. Only income shall be deemed to income attributed to operation carried out in India as and has to be determined in accordance with the rules made by CBDT. What are these? There are three types of income which the CBDT says that they shall be deemed to be income attributable to India. Advertisement which targets Indian customer, or sale of data collected from a person who resides in India, or sale of good or service using such data. If any of these three activities are happening, it shall be deemed that a part of its income is attributable to India. Okay. So you understood the concept of business connection. We understood how the business connection worked earlier and how it evolved into agency, and now the digital significant economic presence. Old rule was non-resident business connection in India, either office in India or employees or agent in India or factory branch physical presence in India. If there was no physical presence, no business connection, no tax in India. This was the law. But digital advertising company. So what happens? A foreign company runs an online advertisement platform. Indian business pay crore to show ads to the Indian customers. Entire system is server outside India, contract set outside India, payment received outside India. So this foreign company has no presence in India, physical presence. So, but he is driving income because Indian customers are paying crores of rupees to this foreign company, and the government must receive some tax. So earlier, government was not able to receive any tax because the foreign company was not present in India, therefore no business connection. But this was economically unfair to India. Similarly, there are foreign platforms which provide online gaming, and Indian youth and Indian people are paying to play that game. Video streaming, cloud software, millions of Indian users they have. They collect subscription fee, but they don't have any physical presence, therefore no tax in India. India was using huge tax base, even though value is clearly coming from Indian users. You getting my point? Similarly, e-commerce. So tax law was designed for factories and offices, not for digital business. This was earlier the law, and therefore SCP was introduced. Physical presence is no longer necessary to earn money because the way the business changed, so the tax has to be changed. There is no other way. Otherwise, government will lose the revenue. So digital economy allows remote selling, remote service, remote data collection. Everything is happening remotely, no physical presence. So India expanded the meaning of business connection to include economic presence without physical presence. Now economic presence matter in the form of if you are driving a revenue of 2 crore or more, or even if you're not driving a revenue of 2 crore, if you are engaging users of 3 lakh, then also it will deem that you have a business connection. If foreign company earns substantial money from India or has deep user engagement in India, India will treat it as having a business connection, even if it never steps into India. You're getting my point? This thing will hit your mind and will retain. So SCP happens through 2 points, through two types of transaction. Either revenue or payment based, 2 crore is the limit. If non-resident enter into transaction with Indian person involving goods, service, property, digital service, and aggregate payment exceed 2 crore, SCP is constitutive and therefore business connection constitutive and therefore income is taxable. So there is a foreign company, online software company which sells software online through its website, which is on a server outside India. But Indian companies pay 10 crore per year. Then this 10 crore exceed 2 crore and therefore the company shall be deemed to have a significant economic presence in India. We are only now at a point in time, I'm only explaining the business connection. Once we develop this concept and we go along to the later provisions, you will realize that income of non-resident taxable even without business connection in some specific situation. We will discuss this today only. So now at this point of time, you only see these examples from business connection point of view. So that this example is only to develop the understanding of business connection, the concept of business connection and significant economic presence. Phone firm provide advisory service via video conferencing calls or via video calls. Indian clients pay substantial fee. All work done from abroad. No presence, no business connection, no. Now, if services are consumed in India, significant payments made SCP. Even if payments are low or indirect, SCP constitute if non-residents systematically and continuously solicit business or interact with users in India. And how many users? 3 lakh users. Through digital means. A number of Indian users exceeds 3 lakhs. So they are free social platform, media platform. Platform is free for user, no subscription fee, revenue earned from global advertiser. I had to give you an example. So Indian user create content, generate data, increase platform value. Indian users themselves create economic value, significant economic presence. Make sense also? So this completes our concept of business connection. No. It only completes the concept what constitutes business connection. Now some relief are given where no business connection is constituted, but the law has exempted. So what are these types of relief? We will study fast because there is not much relevant from exam point of view. In following cases, income of non-residents shall not be deemed to accrue or rise in India. What? Income from operations which are confined to purchase of goods in India for the purpose of export. So if non-residents purchasing goods from India and doing nothing else, his operation are confined to, he's doing nothing else, he's just sourcing the raw material from India and exporting it. Then, though this activity constitutes business connection, as we studied, but it has been specifically exempted. Domestic law. There is one more law which is called the DTL. So I am studying the Income Tax Act, the domestic law of India. There is one more law which calls DTL. And there is section 90 which says if there is a conflict between DTL and domestic law, then who shall prevail? The law which is more beneficial to the assessee. The purpose of only displaying of the damage in India. Actually, the law which is more beneficial to the assessee shall prevail. So we are discussing only the domestic law. The concept of business connection is there in the domestic law, Income Tax Act, section 9. There is a similar concept in DTL as well. We call it PE, permanent establishment. So there may happen that the activity of non-resident qualifies business connection, but there's a definition of P in the DTAA, and it may happen that such activity does not qualify as permanent establishment. In such case, whatever is more beneficial shall apply. Then in such case, the provision of DTAA is beneficial because of DTAA, the P is not constituted. And in such case, even if the non-resident constitute business connection, he shall not be taxable in India because he will take the benefit of DTAA. Okay. If you think this is a heavy class, you can see it one more time. And it will actually it will clear your concepts. So these are very important concepts that the domestic law or DAA is applicable, whichever is more beneficial. So there is a concept of business connection in domestic law, similar concept of permanent establishment in DAA. If the assessee, the non-resident, constitute business connection, but it does not constitute PE in DAA, then even if it constitutes business connection, the income is not taxable because he will take the route of DAA, he will take the advantage of DAA. Now, the question is, what is the purpose of only displaying the damage in India? He is talking about that exemption, which we discussed in the case of foreign company engaged in mining of diamonds. So, the purpose of displaying the diamond is to encourage the sales. The foreigner may come and they see the diamond and they may book the orders. Okay. See, any activity of a foreign person in India will constitute business connection. So, had the exemption was not there, this display would have constituted a business connection and something, whatever little may be, something would have been attributable to India. So, income rising to non-resident from India. If there is a DTL, so it's not compulsory that India has a DTL with every country. There are countries with which India doesn't have a DTAA. So if there is a DTAA, if there is a P in India, income is taxable in India as per DTAA. If there is no PE, income is not taxable even if he constitutes a business connection. Even if there is a business connection, but there is no P, Section 911 shall not apply since DTAA provides that income is not taxable in India in the absence of P. If there is no DTAA, then no question. If there's a business connection, taxable. If there's no business connection, not taxable. I don't have a P. Okay. Concept of P. So this was all about the business connection. Yeah. Okay. We'll take a 5 minutes break and then we can continue. Okay. What we have studied till now? We have studied what is business connection, how is it constituted. It can be constituted by the physical presence of the non-resident, or physical presence if non-resident not himself physically present. If there is some dependent agent who is acting on his behalf, either he's concluding contract on behalf of non-resident, or he's playing a principal role, or he's maintaining a stock of goods on behalf of non-resident, or he's securing order for the non-resident. Then such activity of agent shall constitute business connection for the non-resident in India. Now then we see that because of the technological changes, the law also changed, and the definition of business connection was expanded to include significant economic presence. What do you mean by significant economic presence? It means if you are having a transaction, you mean the non-resident is having a transaction with India, and the value exceeds, the aggregated value for a year exceeds 2 crore, or if the non-resident soliciting goods or engaging with the Indian users of 3 lakh or more, then in either of these cases, the non-resident is said to have a significant economic presence in India. Then we see that if only a part of business operation is carried out in India, then the income attributable to such part shall only be taxable. Then we lastly see that what are the activities which are excluded from the definition of business connection. One, purchasing of goods from India only. The activity should be confined to purchase of goods, or collection of news and views, or shooting of film in India. In case of shooting of film, if the assessee is individual, then he should not be a resident in India, and should not be a citizen of India as well. If the assessee is a firm or a company, then none of its partner or shareholder should be citizen or resident in India. Okay. Then the last exemption was to a foreign company engaged in the business of mining of diamond. If such foreign company displays the uncut diamonds in a special zone, then such activity shall not constitute the business connection. Okay. Now we are moving. See, if you observe, it took us 1 or 2 minutes to revise the concept. It took us almost 1.5 hours to understand the concept. So once you invest time at first instance to understand the concept, it will be very easy for you to revise it. It won't take much time. Rather, it will reduce substantial time, and it will give you a good confidence. If you know the subject conceptually, it gives you confidence. It increases your interest in the subject, and actually a teacher is not one who teaches a subject. A teacher is the one who increases the interest of the student in a concept, in a subject, so that student himself goes and studies the concept, the subject. I try to give you the knowledge which I have, which I could gather from my experience, the practical and the theoretical both, academic both. Okay, without wasting time, let's continue. So, I told you section 9 has a list of income which is deemed to accrue or rise in India. We only covered the first part, the business connection. Now we are moving to other parts of the income. So it says, another part says, income accruing or rising whether directly or indirectly through or from any property in India. If there is any property situated in India, and whatever the income which is deriving from such property is taxable in India, is deemed to accrue or rise in India. So if you have a, say, immovable property in India, a flat or a building or whatever, and you are driving, you mean the non-resident is driving a rent from, is getting a rent from such immovable property, then such rent is deemed to accrue or rise in India, irrespective of the fact the rent agreement was executed outside India, the rent is actually received in the bank account outside India. If the property is in India, any income from such property is taxable in India, because such income is deemed to accrue or rise in India. So generally, there are two types of income which comes from a property. either the recurring income in the form of rent, etc., and then at the time of sale, capital gain. Whatever is the nature of the income, if it is deriving from property situated in India, then it should be deemed to accrue or rise in India. Okay. Then next is if the income accruing or rising through or from any asset or source of income in India. See, you will see here some overlapping. Earlier, the law says if the property is situated in India, then your income from such property taxable in India. Now the law says if the asset is situated in India, then the income of such asset is deemed to accrue or rise in India. The word property is wide enough to include asset. So this overlapping is generally here, seems to be done consciously, purposely. What the lawmaker wants? Lawmaker wants that even not a single income should left, which they want to tax. So there should not be a circumstance which the non-resident may argue that the income which I am driving is not from a property, but it's from an asset. So they are killing the arguments that where the SSC may want to distinguish between a property and asset. Let it be a property, you call it an asset, you call it whatever. I'll treat it as an income deemed to accrue or rise in India. Understood? Then it says, so at place, the law consciously overlaps, gives a provision where and a type of income may come into one or two more. Okay, law says let it be. So I don't mind an income is getting taxed either under clause 1 or 2 or both. What I mind is no income should be left. All income accruing or rising through or from any source of income in India. So what is source of income? Again, if you say have a property in India and you're driving a rent, the source of such rent is the property. So it's covered here also. But source is now even a wider term. I tell you, assuming a non-resident visits India and in a hotel, he has a hobby of a singer, so he sings a song, and hotel pays him some money, and he's not a singer by profession, so as a hobby he sings a song. Now the money he got for singing a song, is it taxable in India? It's not a business connection because he's not a singer. It's not his business to sing song. It's not from a property or assets in India, but the income has a source of from India, and therefore it may be taxable. So see, I'm telling you all this is to broaden your mind that the intent of the legislature, intent of the lawmaker is to keep Section 9 wide so that more and more income could fall into it. Lastly, all income accruing arising through the transfer of a capital asset situated in India. So if a capital asset is situated in India and it is getting transferred, then any income, the capital gain you are getting from such transfer shall be taxable in India. Remember, in case for share debenture of a company are situated where the company is registered. So if the shares of an Indian company are getting transferred, it shall be deemed to be situated in India, and therefore capital gain shall be taxable in India. So irrespective of the fact whether a non-resident sitting in Dubai and doing transaction in Indian company share in the NSE or BSE, the profit which he is deriving from selling or buying of these shares shall be taxable in India because the capital asset situated in India. Now salaries. So what the law say? Income which falls under the head salary shall be deemed to accrue or rise in India if it is earned in India. So what is the meaning of earned? For the purpose of this section, income from services rendered in India shall be regarded as income earned in India. So you see, if the service is rendered in India, then what the non-resident is getting a salary for such salary shall be deemed to accrue or rise in India. This we already know. We have been discussing this since last class. If the activities are performed in India, then the income from such activities deemed to is accruing or rising in India. It's actual accrual. Here the activities are, here the income is salary, And the activities are services for such salary. If services are rendered in India, then it's actual accrual. What was the reason? What was the need to say it deemed accrual? But I tell you, the word deem means whether you have the same meaning, whether you understand the same meaning, very good. But even if you don't feel that the meaning is not for this word, then also you will consider it. So here, we also feel that the income accrue or rise in India, very good. And so, which salary is deemed to accrue or rise in India? If it is earned in India. When it is earned in India, if services are rendered in India. And the rest period or leave period, which is preceding salary from the government of India, was rendering service in USA, outside India, for services rendered by him in USA. In addition, he was allowed perquisite by the government. Which of the following statements are correct? Okay. So this is some MCQ. So here, the SFC is a citizen of India. He is non-resident. He is rendering service outside India and getting a salary from government of India. So the salary, whatever he is getting, is deemed to accrue or rise in India, but Section 10 exempts allowances and perquisite out of such salary. So options are: salary, allowance, and perquisite received outside India are not taxable in the hands of Mr. Ganesh since he is non-resident. It ought to be, but there is a deeming fiction which makes all these things are deemed to accrue or rise in India. Salary, allowance, and perquisite received outside India by Mr. Ganesh is taxable in India since they are deemed to accrue or rise in India. Of course, they are deemed to accrue or rise in India, but there is an exemption available in respect of allowances and perquisite. C is salary received by Mr. Ganesh is taxable in India, but allowances and perquisite are exempt. Perfect. Salary received by Mr. Ganesh is exempt, but allowances are taxable. It's contrary. This is a positive. Next question. Mr. David, a citizen of India, okay, he's a citizen of India, serving in the Ministry of External Affairs in India, was transferred to Indian Embassy in Canada on 31st March 2025. So he was transferred to a Canada. He is a government employee working with the Ministry of External Affairs. These are taxable on source basis. Even if the non-resident is not having anything, is not physically present in India, then also this income are taxable. Let's start with dividend. So we already studied that shares of an Indian company are deemed to be situated in India. Then we studied that income from property or asset in India is taxable. So if the shares of an Indian company is situated in India, then dividend is the income from such asset, and therefore it was taxable under the clause under section 911 only. But here they are specifically saying section 914, which says a dividend paid by Indian company outside India shall be deemed to accrue or rise in India. Had it not been there, still we would have taxed it, because the shares of an Indian company are said to be situated in India, and once an asset is situated in India, any income deriving from such asset is taxable in India. Okay. So law say if any person deriving an dividend from an Indian company, then such dividend shall be deemed to accrue or rise in it. There is one more similarity about these four types of income, is that there is a special rate of taxation, special rate of tax to tax this income. For dividend, there is section 115A. Further, for all these four income, the section 115A provides the rate of tax. So what is the rate of tax the section 115A provides? For dividends, provide 20%. But if the dividend is derived from a unit in IFSC, then the such dividend taxable in the hand of non-resident at the rate of 10%. So if there's a company which is working, which is incorporated in IFSC, and the dividend is paid by such company, then such dividend is taxable in the hands of non-resident at the rate of 10%. Otherwise, if any other company is giving a dividend, then the non-resident has to pay a tax at the rate of 20%. This is a tax rate as per the domestic law, not income tax act. Now, if there's a DTAA, that DTAA may also provide that such dividend shall be taxable at what rate? Say the DTAA provides that dividend shall be taxable at the rate of 15%. Then assessee may apply, whichever is more beneficial, as per section 90 we discussed. And in such case, the assessee would, such dividend shall be taxable at the rate of 15%. But if the DTAA provides that dividend shall be taxable at the rate of 25%, then assessee will apply the domestic law. Because domestic law is more beneficial, and such dividend shall be taxable at the rate of 20%. You getting my point? Section 115A says no expense shall be allowed as deduction against the income referred to in section 115A. 115A gives about list down gives taxes for the 4 types of income: dividend, interest, royalty, FTS. All these 4 types of income are taxed on gross basis in section 115A. If they are taxable under section 115A, then no expenses shall be allowed. But qua dividend and interest, section 115A doesn't even allow the deduction under chapter 6A. But qua FTS and royalty, deductions are allowed. Okay. So this is dividend income. No deduction under chapter 6A is allowed. However, deduction under section 80LA for IFSC is allowed. Also, the 115A says if you're driving the income, you means the foreign company or the non-residents driving the income, refer to 115A only, which is dividend, interest, royalty, or FTS. And tax has been deducted at the rate specified in 115A. Then the foreign company is not required to furnish the return of income, foreign company or the non-resident. So what are the conditions? The NR has the income only in the nature of dividend, interest, royalty, FTS, taxable under section 115A. And the payer has deducted TDS at the rate specified under section 115A. Then the non-resident is not required to furnish return of income. When I say that payer has deducted the TDS at the rate specified in section 115A, I mean that, say, in this case, the rate as per 115A is 20%. But assuming the DTAA provides taxable rate as 15%. Then if the payer has deducted a tax at the rate of 15% because he is legally entitled to, because DTAA provisions are more beneficial than domestic law, then this exemption shall not apply and the non-resident has to furnish the return of income. Why so? Because government says, if you're applying the provision of DTAA, I want to check whether you are actually eligible for DTAA or not. If you're not applying the provision of DTAA, then no worries, don't file a return. I'm happy. I receive my 20% tax through TDS. But if lower tax has been deducted on account of DTAA, then you file a return. Let me actually check whether you are actually eligible for the benefit of DTAA or not. So there are conditions which has to be satisfied for claiming a benefit of DTAA. The government wants to check that. Okay. So the assumption from the requirement of final return of income is available if it satisfies 2 conditions. 1, the income is only in the nature of dividend, interest, royalty, and FTS. 2nd, tax as per 115A has been deducted, not less than that. Now we are moving to 3rd type of income, interest. Now we will do the 3 incomes: interest, royalty, and FTS together. Why? Because the principle when such income is deemed to accrue or arise in India are more or less same for these 3 types of income. What the law says, when these 3 types of income are deemed to accrue or arise in India. But firstly, let me give you an idea what these types of income means. You understand interest. Interest you receive when you give a loan, then you receive interest. Royalty. Royalty is something is paid for use or right to use of intellectual property right, IPR. So assuming you have a patent, you allow somebody to use that patent, you have a copyright, you allow somebody to use that copyright, and such person gives you a sum in consideration of such use. That sum is called royalty. So generally related to intangible assets. Then fee for technical service means the NR is providing, non-resident is providing some technical service and he is giving a fee for that. That's the FTS. So broadly you understood the meaning of all these three items: interest, royalty, and FTS. Now, question is, when such income is deemed to accrue or rise in India, if such income are received by NR, then when such income is deemed to accrue or rise in India. So law says the the answer to this question, it depends upon two facts. First, who is the payer? Who is paying interest, royalty, or FTS? And second, where the principal asset is being utilized. I tell you. Principal asset means if the income is in the nature of interest, then where the money was borrowed, on which interest is received, was utilized. If income is in the nature of royalty, then where the intangible asset for which the royalty is received was utilized. If income is in nature of FTS, fee for technical service, then where this technical service was actually used for which this FTS is paid to the owner. These two things, who is the payer and the actual utilization of money borrowed or the asset or the service, determines whether the income, this interest, royalty, or FTS, is deemed to accrue or rise in India or not. Getting my point? So, what they are saying, if the payer is the government of India, meaning thereby, if government of India has borrowed money and is paying interest, if government of India is using the intangible asset and it's paying royalty, if government of India has availed technical service and is paying FTS, fee for technical service, then nothing have to be seen. If the payer is government of India, then the income of interest, royalty, and FTS is taxable in the hands of a non-resident, irrespective of its utilization. Whether it's utilized in India or not is not relevant. If the payer is government of India, then the interest, royalty, and FTS is taxable in the hands of non-resident, full stop. Okay. Secondly, if this payer is any person other than government of India, then the income, interest, royalty, and FTS shall be taxable if the money for which interest is received, the intangible asset for which royalty is received, if the technical service for which fees is received is actually utilized in India. We see how it is written in the Act, but first you observe two things. We are talking about, firstly, about interest, royalty, and FTS. These three types of money. When we say that it accrue or rise in India, either one, if the payer of interest, royalty, or FTS is the government of India, then such income is deemed to accrue or rise in India. Non-resident has to pay tax on such income, full stop. If the payer is not government of India, but the money borrowed, all the intangible assets, all the technical service are actually used in an Indian business, actually used in India, then the income which the non-resident, income in the nature of interest, royalty, or FTS, which the non-resident is deriving, shall be deemed to accrue or rise in India. Okay, clear? Two things. If the payer is government, income is taxable. If payer is any other person, but the money or asset or service are actually utilized in India, then income is taxable. Income means interest, royalty, FTS. You're with me? Okay. See, now let's see what the provisions say. So, taxability of interest income, section 915. It says, income by way of interest is deemed to accrue or rise in India if the same is payable by the government. Stop. If it, the question is, if it is not utilized in India, then it will not be taxable in India. Is that right? Of course. It depends. If the payer is not a government and the money borrowed is not utilized in India, then shall not be taxable in India. And we will do it with example, you will understand it crystal clear because it makes sense as well. Assuming there is an NR, Mr. A, he lends money to Mr. B, another NR, in a foreign country. Mr. B pays a interest to Mr. A. Where is the India? How can India tax it? There has to be some nexus. So nexus is built either for government or if Mr. B invests this money in Indian business, then the interest which the Mr. B is paying to Mr. A is deemed to accrue or rise in India. So what I have to see? I have to see where the money borrowed in respect of this interest is arising is actually utilized. If money borrowed is utilized in India, then only this interest is taxable. Except a case where the payer is the government, of course. So, if income by way of interest is deemed to accrue as in India, if the same is payable by the government or if the same is payable by a person who is resident. So, Mr. A is non-resident and he has lent a money to a resident. So, he is driving, the non-resident is driving interest from resident. Then interest is payable in respect of any debt incurred or money borrowed and used for the purpose of business or profession carried on by such person in India. Who is such person? Means a borrower. Or for the purpose of making or earning any income from any source in India. So if he, the resident person, has utilized the money for his business profession in India or for earning any income from any source in India, then the interest which the Mr. A is receiving from this resident person shall be deemed to accrue or rise in India. So, what we said, interest shall be taxable if money borrowed is used in India. Understood? Now the law say, if the interest is payable by a person who is non-resident. So, Mr. A has lent the money to an NR outside India. Interest is payable in respect of debt incurred or money borrowed and used for the purpose of business or profession carried on by such person. Such person means NR in India. So this interest will be taxable if NR is actually using this money in his business in India. So we discussed this only. Ki interest is taxable either it's payable by the government or the money borrowed is used in India. See, if it is resident, it's taxable if it is used in the business profession in India or earning any source of income in India. If the payer is non-resident, it is taxable if it is used for the business profession of such non-resident in India. Means this NR is doing some business in India and he has utilized this money in this business of India. Okay? Similar is the case with royalty. Income by way of royalty deemed to accrue or rise in India if the same is payable by the government or same is payable by the resident, where when royalty is payable in respect of right, property, or information used or service utilized for the purpose of business or profession carried on by such resident in India or earning any income from any source in India. Understood? If the non-resident is deriving a royalty income from a resident, then such royalty income shall be taxable in the hand of non-resident only if such resident utilize the asset, IPR, in its business in India or for earning any income from any source in India. Similar to interest. Or if the royalty is earned from a non-resident, then even that royalty can be taxed in India provided the royalty is payable in respect of right, property, of information used or services utilized for the purpose of business or profession carried on by such person in India or for earning any income from any source in India. Understood? So if Mr. A has given his IPR to a non-resident and he is receiving royalty from this non-resident, this royalty shall be taxable in India in the hands of Mr. A if the non-resident has utilized the IPR, right, property information, in its business in India or for earning any income from any source in India. Understood? Similar to interest. This is what we discuss that these income are taxable if the payer is the government or the money borrowed or the IPR asset or services are utilized in India. So even if the payer is resident, the income is taxable if the money borrowed is used in India, or the payer is non-resident, the income is taxable if the money borrowed or asset are used in India. Similar would be the case in case of FTS. Income by way of fee for technical service is deemed to accrue or rise in India if the same is payable by the government or payable by the resident, where the fees are payable in respect of services utilized in a business or profession carried on by such resident in India, or for earning any income from any source in India, or where the fee for technical service payable by non-resident, where the fees are payable in respect of services utilized in a business profession carried on by such non-residents in India, or for earning any income from any source in India. The same thing. If the payer is government, then the fee FTS is taxable in the hands of NR. But if pays other than government, then same is taxable only if the services are utilized in India. Okay. So we studied three different clauses: interest, royalty, FTS. If payer is government, taxable, taxable, taxable. If payer is resident, taxable if the money borrowed is used in the business in India or earning any income from any source in India. Royalty is taxable if the right property of information in respect of which royalty received is used in the business in India or for earning any income from any source in India. FTS, if the services are utilized in the business in India or for earning any income from any source in India. So, same, no difference. If the payer is resident, then income is taxable only if it is utilized in India. The main thing, the money borrowed, the asset, or the services. If the payer is non-resident, then interest is taxable if money borrowed is used in the business in India. Royalty is taxable if the IPR is used in the business in India or earning any income from any source in India. FTS is taxable if the services are utilized in the business in India or earning any income from any source in India. Wait, sir. Wait. Here seems a difference. There are two clauses in FTS and royalty. There is only one clause in interest. It's actually the same. You observe the right thing, I tell you. See, this is the only precise difference between the accrual of these three income. In case of FTS, if the payer is non-resident, it is taxable if the services are utilized for business in India or earning any income from any source in India. So either the non-resident, the payer non-resident, is having a business in India in which this services are utilized, or is having any source of income in India in which this services are utilized. In both these cases, the FTS which the non-resident is receiving is taxable. Is deemed to accrue. In case of royalty also, if the payer is non-resident, then that royalty is taxable if this non-resident payer has utilized the right property information in its business in India or for earning any income from any source in India. But if you see the interest, the second link is missing. If the interest is payable by a non-resident, it is taxable only if the money borrowed or debt incurred is used in the business in India. The word for earning any income from any source in India is missing. So, what the conclusion is? If interest is received by NR from another NR, then such interest shall be taxable only if the payer has used the money borrowed in his business. Say, for an example, A is NR, he lent a money to another NR. Okay? The borrower, what does he? This borrower invests this money into the shares of Indian company. Okay. But this buying and selling of shares is not his business. He purchases a share as an investment. Okay. Now, the interest which the A is driving from this NR is not taxable. Why? It can be taxed only if this NR has used the money in his business in India. He has used the money in India, but not for his business. He used the money for earning any source of income in India. And this is not taxable. You with me? You understood the precise difference? My most of the questions in exam or RTP are in respect of this only. Okay. Now we understood the concept of accrual for these three types of income. Now we will deal each of this income independently and understand two things. One, what is the meaning of this income? What do you mean by interest? What do you mean by royalty? What do you mean by FTS, fee for technical service? Yes, Sanjay ji. Money borrowed IPR technical service if used in India, then taxable. But there is one exception, small exception, in case of interest. If the interest is payable by non-resident and that non-resident use the money borrowed for earning income from India, not for business in India, then such interest is not taxable. But for royalty, FTS, it's taxable. Okay. So we have understood the concept of accrual in respect of these three income. Now we will deal each one of them individually to understand two things. One, the meaning. What does we mean by interest, royalty, and FTS? And second, the tax rate. So we understood the taxability, when they are taxable, when they are not taxable. Now we understand what does it mean and at what rate it's taxable. Okay. Sorry. So we'll start with the interest. So what do you mean by interest? You all understand interest? The act defines interest. It means interest payable in any manner in respect of money borrowed or debt incurred, including a deposit, claim, or other similar right or obligation, and includes any service fee or other charge in respect of money borrowed or debt incurred in respect of any credit facility which has not been utilized. So the definition is widely worded. First, it means anything which is payable in respect of money borrowed. You understand money borrowed? I took a loan from you and pay you interest. So that amount which I pay to use your money is called interest. Taxable as interest. What do you mean by debt income? Debt income means there is not a formal loan agreement, but I am required to pay you money for something. Say I purchase an asset from you and did not pay the amount. Though there is not a formal loan agreement between you and me, but I own a debt against you. You own a debt against me rather, and whatever I pay in addition to the sale consideration is the interest. Definition also includes service fee or other charges, means the processing fee, etc., which the bank charges while disbursing a loan, also qualify as an interest. Okay. So the definition is very logical one for the interest part. Now we'll move to the taxability. So taxability is given by under section 115A. Gross basis, no expense, no deduction in chapter 6A. It says, what's the tax rate? Interest income earned by non-resident or a foreign company is taxable as under. Interest received from government or Indian concern on monies borrowed in foreign currency. So taxable is at the rate of 20%. But if interest is received in respect of infrastructure debt fund or interest referred to one for LC or LBA, the tax rate is 5%. What is this LC, LBA? We'll discuss when we will discuss the TDS provisions. Okay. So for the time being, if you remember the interest rate of taxability of interest 20%. Same rate was there for dividend and same rate is there for royalty and FTS. I told you this four income is taxable under section 115A. dividend, interest, royalty, FTS, and principally they are taxable at the rate of 20%. Okay. Okay. No expense, no deduction, but deduction is allowed in respect of royalty and FTS. Similar provision, non-resident is not required to furnish return of income if income is only in respect of interest, dividend, royalty, FTS, and tax at the rate specified under section 115A has been deducted, which we discuss in the case of dividend as well. One small point, tell me, a non-resident has made a deposit with the Indian bank and is getting an interest from the Indian bank. This income accrue arise in India, no doubt. Question is, what is the tax rate on this interest? Will this interest be taxable at the rate of 20%? Tell me. Fast. Why no? So the answer is no. Correct answer is no. Why no? The more important is the reason. I want to know the reason. Why this? Because this is an interest. This comes in the definition of interest as we studied. It includes deposit as well. So why this interest is not taxable under section 115 at the rate of 20%? Because the interest is the assessee is non-resident and the interest is received from a foreign Indian concern, the bank. But the answer is no, because the bank has not borrowed money. You have made your deposit voluntary. Bank has not borrowed from you. And therefore, this 20% interest, 20% tax rate is not applicable on interest from bank deposits. Such interest taxable at the normal rate, applicable to the non-resident. Perfect. So Sanjay ji knows this. Good. Interest, one small point. The law says if there is a PE in India, now you know the PE, permanent establishment, means there is a head office, it has a branch office in India. So this is outside India, this is in India. So it has a branch in India. This branch in India qualifies as a PE. Now the law says if this branch pays interest, it has borrowed money from HO, and it pays interest to HO, outside India. Then whether this interest is taxable in the hands of HO, tell me. The logical answer is no, because HO and branch are not two separate entities. Branch is only an extension of the HO. Okay, it's not a separate legal entity, it's only extended arm of the HO. So it's actually money picked from one pocket and shifted to another pocket. Either two pockets of same person, they are same person. Okay. But the law says if this branch is a banking, this company is engaged in the business of banking, then this interest paid by one branch to the HO or to another branch of this company, this enterprise, such interest shall be deemed to be the income of the recipient, even if they are branch. And this branch is required to withhold tax. So what does it say? Interest paid by a PE in India of a foreign bank, if such bank outside India shall be deemed to accrue or rise in India in the hands of recipient. So this deeming fiction applies only in case of bank. Had this branch been for a normal enterprise, assuming there is a company, the Pepsi has a branch in India, and this branch has taken a loan from his head office and is paying interest, then such interest shall not be taxable in the hands of head office. But this deeming fiction, this taxability has been invoked, has been levied only in case of banking company. Okay. We have done all this. Now we are moving to before royalty. Let's discuss the FTA, the smaller one. Fee for technical service. We understood when the fee for technical service it accrues in India if the payer is government or if the services are utilized in a business profession in India or for earning any income from any source in India. Okay. Now we need to understand the meaning of FTS. FTS means consideration for rendering any managerial, technical, or consultancy service, including provision of service of technical or other personnel, but does not include consideration for any construction, assembly, mining, or like project undertaken by the recipient, or consideration which will be the income of recipient chargeable under the head salaries. There, let's break this definition into some smaller parts. First, it says FTS means consideration for rendering managerial, technical, or consultancy services. So, if the non-resident is rendering either the managerial service or technical service or consultancy service, then the fees which he is getting for this is called fees of technical service. What are managerial service? Is in the nature of managerial activity. What are technical service? Involves a technical subject. Consultancy generally means advisory. Okay. What happened is that in the case of Bharti Airtel, the matter reached to the Supreme Court qua interpretation of the word technical service used in definition of FTS. See, interesting judgment. You will like it. What the Supreme Court said is that the word technical is preceded by a word managerial, is succeeded by a word consultancy. So the word technical is sandwiched between managerial and consultancy service. So the meaning which the word technical shall derive, it shall derive the meaning from its neighbors, managerial and consultancy. And both these words, the managerial service and consultancy service, require human element. Neither the managerial nor the consultancy service can be provided by the machines. And therefore, though technical service can be provided by the machine, but if technical services are provided only by machine without human intervention, such technical services shall not qualify as fee for technical service. Why? Because they are preceded by managerial and consultancy, which has to involve the human, which has a human flavor, which mandatorily requires human intervention, and therefore technical service shall include only those service. Technical service here in this definition shall include only those service which require human intervention. If the technical service are being provided without human intervention, then they shall not be called as FTS. See, there is a relevance of this definition because I told you the FTS, royalty, interest, and dividend taxable even if the non-resident does not have a business connection of PE in India. So if by some definition, by some interpretation, the NR could come out from FTS, then the revenue is deriving from technical service shall not qualify as FTS and shall not be taxable in the absence of business connection or PE. So therefore, there is always a tussle between the government and the assessee. Government wants that the revenue, the fees which the non-resident is getting for the service, that service should qualify as FTS as we find here. And the non-resident tries that my service is outside this. So if the non-resident could prove that the service I am providing for which I am receiving the fee is only qua machines, there is no human intervention, then the service, the fee which he is receiving shall not be taxable in India unless it is attributable to his business connection or permanent establishment in India. Hope you clear. Okay. You understand? Adjustum generis. Perfect. So Sanjay is saying adjustum generis means bird of same feather fly together. A word takes the meaning from its neighbors. Okay. So what are FTS? It means either managerial or a technical or a consultant service with a human involvement. Then it includes provision of service of technical or other personnel. It means if the entity, the non-resident, is lending the employees, giving the employees, is in the manpower, is lending the manpower to the payer, and for which he is receiving the fees. And such manpower is technical. Then also the fee is called technical, fee for technical service. Now this is the definition. Now comes the exclusion part. But it does not include, let's just see, consideration which would be the income of recipient chargeable under salary. Of course. So you are a technical person. You join a company as a CA. Whatever you're receiving as an employee, it shall be taxable as salary, not a fee. You're not a consultant. So of course, if a because employee provide technical service, and in a consideration he receive salary. Whatever he receive, we call it salary, not the FTS. So logical. Another exclusion is the consideration for construction, assembly, mining, or like project undertaken by the recipient. So if the recipient is taking a construction project or mining or similar projects, he is receiving a revenue fee for such project for doing this project, then the amount so received is not called FTS. Why? Because generally the FTS doesn't require a lot of cost. Rendering this technical managerial service. It's in the nature of service, not in the nature of business. So that's why FTS is taxable on gross basis. I told you this four income are taxable on gross basis at 20% without allowing the expenses. But if you see, if you're doing construction, assembly, mining, or similar project, then a lot of expenses are incurred in this. And to tax these income on gross basis is not justified. And therefore, the law has excluded these revenue from the FTS. Now, if you are deriving this revenue from construction activity in India or from mining activity in India, if you're doing some construction activity in India, then of course you have a business connection. Then these revenues shall be taxable in India on net basis after allowing your expenses as we do in normal business. Okay. So this was the definition of FTS. So one thing, FTS does not involve service which are provided without human intervention. It happens, see, there are a lot of highly technical industries where the service are provided only core machines. Yeah. These, if I give you an example, these include if an aeroplane is required repair or maintenance, then there's a case by the name Lufthansa. In this case, it was discussed that the aeroplane was sent to outside India, and the aeroplane was repaired or maintained only core machine without human involvement. Then the amounts were paid by Lufthansa to outside to the special rate provided under section 115A. What it says, where an NR or a foreign company has PE in India or perform professional service from a fixed place of profession situated in India, and the right property or contract in respect of which royalty or FTS is paid is effectively connected with such PE or fixed place of profession. So the services or the right property information is provided by the PE in India. So the income is connected with the PE. In such case, the income by way of royalty or FTS received from government or Indian concern shall be computed into that PGBP in accordance with provision of the Act after allowing expenses and taxable at normal rate. So in this case, 115 shall not apply. Assessee doesn't have a choice. If the royalty and FTS is effectively connected with the P, then a tax shall be computed in section 44DA on net basis after allowing all expenses. And the tax rate shall be the normal tax rate applicable to the assessee. The individual, then a slab rate, if a company, then 35%, as the case may be. The provision of section 44BB shall not apply in respect of income referred to in this section. It is section 44BB. We will discuss this in next class when we will do the presumptive. The Foreign company or the NR shall keep and maintain books of account as per section 44AA and furnish the audit report on or before the due date of furnishing tax audit report section 44AB. So we'll maintain the books of account, get the books of account audit and furnish the audit report. This shall happen when the royalty or FTI is effectively connected with the PE, then 44DA shall apply. If it's not connected with the PE or if there is no PE of the non-resident in India, then 115A shall apply. The difference is in 44DA, the income is taxable on net basis. In 115A, the income is taxable on gross basis. In 44DA, the income is taxable at the rate applicable to the assessee. In 115A, income is taxable at the rate 20%. In case of 44DA, the assessee is mandatory required to maintain books of account, get the books of account audited and furnish return of income. In 115A, assessee can get the exemption from furnishing return of income. Okay. Now, last topic for today, we'll discuss the definition of royalty. This is important from your exam point of view. So, review the class till end. Royalty means consideration, including any lump sum consideration, but excluding any consideration taxable under capital gain. When the consideration can be taxable under capital gain. See, you know what is royalty? Broadly, royalty means when a non-resident giving a right to use of IPR, intangible property asset, intangible properties, rights to any person, and the sum the income he is deriving for giving such right to use called royalty. See, I have written a book. I have allowed a publisher to publish a book, and whatever he sells, he will give a percentage of the sale price to me. The amount which I receive is called a royalty, copyright royalty. I have given a copyright. There may be a case when I sold the copyright at one go. I said the publisher, you give me a lump sum amount, say whatever amount, and you publish n number of copies. You do whatever you want to do with the copyright, and don't give me any royalty. So in this case, I have sold my right, my copyright. The copyright is a intangible right, property of any kind, capital asset, and the amount which I have received shall be taxable as capital gain. In that capital gain, no royalty. So here we are not talking about the complete transfer of a right. We are talking about the lump sum. We are not talking about the lump sum amount received for transfer of a right. We are talking about the amount which I am receiving for allowing the right to use. Okay. So what the royalty means? Transfer of all or any right in respect of patent, invention, model, design, secret formula or process of trademark or similar property. If I have patent, I have invention, model, design, secret formula, process or trademark, and I allow other person to use it, to use that patent, to use a formula and prepare a medicine, to use my trademark and do the same, then the amount which I am receiving for allowing that person to use is called royalty. The imparting of any information concerning the working or use of patent, invention, model, design, secret formula, process or trademark. The use of patent, invention, model, design, secret formula, process, or trademark. The first three clause relates to these intangible assets: patent, invention, model, design. You need not to remember the definition. You just have a feel of it. Understand the conceptually. Then royalty also includes imparting of any information concerning technical, industrial, commercial, scientific knowledge, experience or skill. If I have some scientific knowledge, I'm giving that knowledge to a person and receiving something, that it could be called royalty. Royalty also includes if I'm allowing the other person to use industrial, commercial, scientific equipment, not only intangible, now it's tangible also. Only qua industrial, commercial, scientific equipment. Or the royalty includes any amount received for transfer of all or any rights. Very important. In respect of copyright, literally artistic, scientific work, including film or videotapes, for use in connection with television or tape or use in connection with video production. So I have developed a content, I have a copyright, I have a scientific work, I have a literary work, and I'm allowing you to use it. And for this, if you're making a payment to me, this shall be taxable as royalty in my hand. It also includes consideration for sale, distribution, exhibition of cinematographic film. So, when a producer makes a film and it distributes it to a distributor, the amount it receives from the distributor is called royalty. Or rendering of any service connection with activities referred to in subclause 1 to 6. If I have given you a equipment, scientific equipment, the amount which I'm receiving from you for allowing you to use such equipment for royalty. If I'm also providing a service, say installation service to you for the scientific equipment, then the consideration for such service shall also be deemed to be a royalty. Okay? So you cannot bifurcate a transaction artificially into two. Transaction of one, that I am allowing you to use the scientific equipment. Then the amount I'm receiving is royalty, whether you call it as a for the use or you separate it as installation fee. But in both cases, it shall be taxable as royalty only. Because the main element is royalty. Okay. Now comes, see, we are talking about a earlier period where the computers were rare. Yeah. So India was in need of computer, and the Microsoft was the one who was actually entering into contact with the governments of the country, not with the people of the country. Microsoft was actually dealing with the Indian government, with the government of different countries, because it was the only person who has a computer and the government wants computer. Okay. So what happened is that if computer has a software, so there was an issue that if the Microsoft sells computer to the India, then Indian tax authority may say that it's actually for the use of software within the computer, and therefore the amount which the Microsoft is getting from India shall be taxable as royalty. To give relief to the Microsoft, because Microsoft was having a monopoly at that time. This provision was inserted, which said that lump sum payment made by a person who is resident for transfer all or any rights, including granting of license, in respect of computer software supplied by non-resident manufacturer, along with the computer under any scheme approved by government, shall not be considered as royalty. It says, if the Microsoft is supplying the software, or any other person is supplying the computer, and the computer has a software, then the amount which he is receiving for this computer shall not be taxable as royalty. This is to cancel that argument of tax authority that it has software and therefore the amount should be treated as royalty. Okay. But subsequently, see, this computer software is a big issue in the definition of royalty. We'll discuss this third way. Okay. It won't take much time. No worries. What happened is that, I tell you, what happened is there's a foreign company which has developed some software. Now it sells the copy of the software to people. So question comes whether this copy of a software, whether the amount paid to purchase this copy of software, can it qualify as a royalty? Is it for you the right to use the copyright? So the court said that, and rightly so, that there is a difference between a copyright and per se copyrighted article. So what the buyer has purchased is not a copyright. He only purchased a copyrighted article. See, I write a book. I sell this book to you. So what I have received? Have I received a royalty or have I received a sale consideration for sale of a good? It's actually a sale of a good. You have not received a copyright. You cannot exploit a copyright. You cannot make copies of this book and sell it. I am talking legally, right? So copyright remains with me. I have not given a right to use copyright to you. I have only sold a copyrighted article. T series T series creates music, right? It sells CDs having the music. When you purchase a CD, you don't purchase a copyright in the music. You only purchase the article. The amount which a T series receives from you is the sale consideration for a good, for a copyrighted article. This sale consideration is not taxable as royalty. You understanding why we are discussing all this? Because if it qualifies a royalty, then it shall be taxable in the hands of non-resident, even if non-resident doesn't have a P. But if it doesn't qualify as a royalty, it shall not be taxable unless the non-resident has a P. So, you understood? Similar thing we discussed in the FPS as well. This is a big controversy which was there since very long. So, what happened is that Indian customer used to download software from, say, Adobe website and used to make the payment to Adobe. The question came, the tax authorities want Adobe to pay tax on this amount received from the Indian customer, treating it as a royalty because royalty is taxable on gross basis, even in the absence of PE. Clearly, Adobe doesn't have a PE, doesn't do anything in India. So this was a controversy. Courts have consistently held that this amount is not a royalty, it's a for sale of copyrighted article and not taxable. But Indian government doesn't like it. It brings an amendment. What it says, royalty includes consideration for transfer of all or any right for you, the right to use computer software. Now it has increased the scope and included the word computer software instead of copyright. Copyright is still there. Our copyright is there. Copyright. But now, if the amount is received for use the right to use copyright, it's royalty. No question. But if the amount is received for use the right to use of computer software specifically, then also the amount is called royalty and taxable. Understood? Okay. But I told you, there's always two things. One is domestic law and another is DTL. So the amendment is made in the definition of royalty under domestic law. The definition of royalty has been expanded in the domestic law. And by extension, even the purchase of copyrighted article in respect of computer software means purchase of computer software per se is treated as a royalty. But there is no change in DTL. So if there is a DTL, then DTL has the same definition that royalty means use or right to use of copyright. So if there is a DTL, then the payment shall not qualify as royalty under the DTL and therefore not taxable. And the assessee shall be eligible to claim the provisions of DTL because it is more beneficial. Okay, you are with me? Similar case was there before the Supreme Court in the case of engineering analysis center of excellence, where the court said that, engineering analysis center of excellence, where the court said that though the definition has been expanded in the domestic law, but if there's a treaty and definition, the assessee shall be eligible to invoke the provision of treaty if this is more beneficial. And the definition for in the treaty is same. Has not changed, which is payment. Royalty means payment for any kind received in consideration for use or right to use any copyright. It does not use the word computer software. So there is no use or right to use copyright. So the payment shall not qualify as royalty under the DTL and therefore the non-resident is not liable to tax. He can take the advantage of DTL. Though the taxability arises under domestic law, but if taxability doesn't arise under the treaty, then the non-resident can take the benefit whichever is more beneficial to him. So the apex court, the Supreme Court observed that in these 4 cases, under the treaty, the payment does not qualify as royalty. What are these cases? You will feel it's very logical. Where computer software is purchased directly by an end user resident in India from foreign non-resident supplier or manufacturer. I am purchasing computer software, the Indian resident. So the foreign supplier, non-resident supplier, whatever he is receiving is not royalty under the treaty. Where resident Indian companies acting as a distributor or reseller purchase computer software from foreign supplier and then resell the same to resident Indian. So there is a distributor in India and he purchases software. What does he do? He just purchases as a good. He doesn't do any change in such software. He purchases the software and sell it to the customer. So whatever the foreign company is receiving from the Indian distributor cannot qualify as royalty under the treaty. Where the distributor happens to be a foreign. So there is a foreign person who's the manufacturer. The distributor is also foreign, who after purchase software from the foreign non-resident seller, resell the same to the resident. So whatever you say. So amount which the resident pay to this distributor or this foreigner pays to another foreigner, to the manufacturer, to the developer. In both the cases, the amount is not royalty under the treaty because it's not for the user right to use copyright. The copyright remains with the developer in all these cases. The developer is only selling a copyrighted article. Hope I'm clear. Where computer software is affixed onto hardware. Okay, this is similar to if we study. This says that if, take an example of a mobile. If you purchase a mobile phone, then mobile phone comes with the apps, software. Can we say that we are actually purchasing the software? No. Predominantly what you have purchased the mobile phone, the hardware, the equipment. This software has no use without the mobile phone. You cannot use it standalone. So in this case, the court said that in the case of Alcatel-Lucent, that this payment for purchase of an equipment embedded with the software, purchase of a hardware embedded with the software, whether predominantly the customer wants the hardware, then the amounts of paid shall be deemed as a sale consideration, shall not be treated as a royalty. You see, where computer software is affixed onto hardware and sold as an integrated unit or equipment by foreign, non-resident supplier to resident Indian distributor or end user. Therefore, in specified case mentioned above, okay. We have discussed okay, this interest we have discussed, this we have discussed. So, you understood the meaning of royalty? There is one more clause in the definition of royalty. This is these 2 clauses. So, under domestic law, the use or right to use of computer software has been deemed to be royalty and therefore taxable as royalty. If there is no DTAA, then it shall be taxable in the hands of non-resident, even if it's a copyrighted article because deeming fiction has been created. But if there is a DTAA, then depending upon the language of DTAA, the NR can take the benefit of the provision of DTAA if they are beneficial to him. Now comes one more interesting case. See, what happened is that there is a Star TV. It makes the programs and serials. So it telecasts this serials. There is a company in Hong Kong by the name Asia Satellite. What does this company do? It owns satellites. So, for what purpose? So, this Star TV produces a program serial under the sea. We call it undersea cable. And most of our telephone data, when we dial here to the UK, data travels through these undersea cables. And these telecom companies pays some amount to this undersea cable to use their capacity, the Airtel, Tata, whatever. Now, what happens is that the question comes whether the amounts were paid by the Bharti Airtel to this undersea cable company to use this facility, can this be called as a royalty? Similarly, the Bharti Airtel does not have a right to use the cable. The cable is used by the cable company only to provide a service to the Bharti Airtel. And therefore, the amounts received by the cable company cannot qualify as a royalty. You understanding the fact that where it is coming from? Why the government wants to treat every revenue as royalty or FTS? Because in such case, it shall be taxable even without a P. But if this payment received by Asia Satellite, payment received by this undersea cable company, doesn't qualify as a royalty, then it cannot be taxed in India in the absence of P. And of course, there is no P, there is no allocation. They are not doing anything. They just have a cable, they just have a satellite outside, not even outside India, outside the earth, in the space. Okay. So the courts held in favor of the assessees, but the government made an amendment. Again, the domestic law. The amendment is consideration, royalty includes consideration in respect of right property information, whether or not means irrespective of these things, whether or not the possession or control of such right property information is with the payer, even if the right property information is not with the payer, the control of such right property information, control of the asset is not with the payer, still the amount shall qualify as royalty. Actually, this is the service, but they have called it as a royalty. Even if, irrespective of the fact, the asset is used directly by the payer. Even if the asset is not used by the payer, who is using the asset in this case? The recipient. Because he is using the asset to provide the service, but still it's called royalty. This is the beauty of deeming fiction, power of deeming fiction. Irrespective of the fact that location of such right is in India. In this case, the asset was in space or undersea. Okay, to overdo all these things. Then similarly, it helps that the expression process include transmission by satellite. So if you're making a payment for transmission by satellite, it will include a process, right to use the process. Whether the process is under your control or not, whether it's used by you or not, whether process is in India or not. These two has to be read together. Including uplinking, amplification, conversion for downlinking. Process include transmission by cable, optic fiber, or any other similar technology, whether or not such process is secret. So now you can understand the meaning of these two definition with the help of example. Now you know why this definition was inserted. Okay. So the amendment, the definition of royalty has been expanded under the domestic law. But in the DTAA, still the definition is restricted one. And if there's a DTAA, then you can take the benefit. Okay. Lastly, there's a point that this, we have already discussed this, that income of non-residents shall be deemed to accrue or rise in India under Clause 5, interest, Clause 6, royalty, Clause 7, FTS, and shall be included in the total income of non-resident, whether or not the non-resident has a residence or place of business or business connection in India, whether or not the non-resident has rendered services in India. So even if the non-resident doesn't have a PE or business connection in India, still the interest, royalty, and FT is taxable. We know. But it says, even if the services are rendered outside India, still the income is taxable. Because we discussed Here, the concept of accrual is dependent upon two factors. One, the payer. If the payer is government, then the income is taxable irrespective where it is utilized, irrespective where it is rendered. But if the payer is other than government, then it's taxable where it is utilized. The place where it is rendered is irrelevant. If it is utilized in India, then it's taxable in India. So if you say you are an Indian, you approach a US company for a report. A US company sitting in the US prepare a report and send it to you. And you have a business in India for which you require this report. The amount you pay to the US company is FTS and it accrues in India because the report is utilized in India. The fact that the services were rendered in US is irrelevant. This is deeming fiction because we studied that accrue arise when the services are rendered. But here, even if services are rendered outside India, but if it is utilized in India, then it's taxable in India. Qua, royalty, FTS, and interest. You understood? So royalty, FTS, interest, the principle of accrual are different. They are dependent upon the payer or where the money borrowed or asset or the services are utilized. You with me? Okay. Let's quickly do some questions so that you get an idea how the questions are asked. Then we will conclude today's class. We have a similar question where we have discussed where a non-resident borrows the money from another non-resident and he used the money borrowed for a share purchase of shares in India. Then the interest to pay shall not be taxable because in case of interest, it is taxable if the non-resident uses the money borrowed for a business or profession in India. The clause, so earning any income from any source in India is absent in case of interest. You can do this in homework, and if you face any difficulty, do ask me in the next class. We'll do this. We have similar case. Let's study Alcatel-Lucent, where we discussed about supply of hardware with the software. Atlant, Italy, a company incorporated in France, was engaged in manufacture, trade, and supply of equipment and services for GSM cellular radio. Same facts of Alcatel-Lucent. Will these not be uploaded today? They have already been uploaded, man, sir. It supplied a hardware and software to various entities in India. Software license by SSC embodied the process which is required to control and manage the specific set of activity involved in the business use of its customer, and also made available to its customer who use it to carry out the business activity. The AO contended that the consideration of supply of software embedded in the hardware is royalty. You know, the software is embedded in the hardware is used only for the hardware. It cannot be treated as hardware as royalty. Predominantly is a purchase for the hardware. So question number 9 is similar to the engineering analysis center of excellence facts. That a computer software shall not be treated as a royalty under the treaty. So here the treaty says definition of royalty and the treaty is payment of any kind. It's a copyrighted article. Computer software, right? For the treaty, it's still a copyrighted article. Payment of any kind received as a consideration for use or right to use any copyright. See, what happens is that in the domestic law, they have said that payment of any kind received as consideration for use or right to use computer software. So, when I purchase a software, I purchase it to use it. So, therefore, it's taxable as a royalty. But it's actually a product. I have not purchased the copyright. I have only purchased a copyrighted article. I have tried to explain so that I feel it's quite a heavy class. You can repeat, you can view it 2 or 3 times, but the content is really good, and it is difficult that you find such content otherwhere, and also it's important for you to have the conceptual knowledge. Okay. JJ Limited, a company incorporated in Australia, has entered into an agreement with KK Limited, an Indian company, for rendering technical service to the latter for setting up a fertilizer plant in Odisha. So the company is an Australian company, foreign company. It has entered into an agreement with Indian company for setting up a plant in Odisha. As per agreement, JJ, the foreign company, rendered both offshore service. Offshore service means service while sitting in Australia, not in India. And onshore service to KK Limited. Onshore service means he has to come to India. The employees of the JJ has to come to India at a fee of 1 crore and 1.5 crore respectively. So 1 crore is received for providing technical service from offshore. 1.5 crore is received for providing technical service onshore. JJ Limited is of view that it is not liable to tax in India in respect of 1 crore. So it says that the 1 crore is received for rendering service from outside India, service rendered from outside India, and therefore it's not taxable. As it is rendered from outside India. Discuss the practice. So what happens is that generally, when Vedanta or this heavy industry companies, what they do is that they enter into an agreement with a foreign company for setting up their plant in India. So the agreement involves 3 or 4 lakhs. It first involves sale of equipment by a foreign company. Then it involves installation and training of employees of Indian company. For this, they receive consideration. It involves drawing and design of services for the Indian company. Now, this sale of equipment is the offshore sale. Is taxable only if this company has a PE. Okay. This drawing and design and training services are FTA services. This is provided from offshore while sitting outside India. But for training, the employees of foreign company has to come to India. This is provided onshore. So there is no issue about the taxability of this onshore. This taxable in India because rendered in India. No dispute. What the pain point is, the amount received from drawing and design. So these are provided from offshore, but these are taxable because in FTS, the place where the services are rendered is not relevant. What is relevant? The place where they are utilized. This drawing and design services are provided for setting up a plant in India. So they are utilized in India and therefore even offshore services are taxable. So in this case, these are utilized in India. Perfect. So in this case, the argument of JJ Limited that 1.1 crore rupees is not taxable because services are rendered outside India is have no relevance because they are utilized in India, therefore taxable in India. What is relevant is where services utilized, not what is where services are rendered. Therefore, the view of JJ Limited is not correct. Similar questions are asked. See, it was an exam question on May 23. Let's do this. So here, similar question. ABC Inc., a company incorporated in Korea, entered into an agreement with XYZ Limited, Indian company. The Korean company entering into a contract with Indian company for providing assistance to the latter for setting a plant in Gujarat. The scope of work includes offshore service in the nature of drawing and design of electrical networking work. Even though it's a offshore, it's taxable because it lies in India. Right? Onshore service in respect of installation of machinery, anyway, taxable. It's entered in India, utilized in India, both. The consideration for the scope of work was agreed to be 3 crore for offshore. This was for 3 crore taxable and 2 crore for onshore taxable. The consideration was discharged as under. 3 crore in respect of offshore was paid to ABC bank account in Korea. Though it is received it outside India, but it accrue or deemed to accrue or rise in India, therefore taxable. Because services are utilized in India. But in respect of 2 crore, what the question says, this 2 crore discharge by way of 6% debenture for 2 crore were issued on 1st September in consideration of onshore service. So instead of making a cash payment of 2 crore, what the Indian company does, it issues its debenture. Indian company issued debenture to the Korean company. The Korean company receive a debenture instead of a money of worth of 2 crore. Then this debenture so received will qualify as FTS. So when the amount is paid in cash or in kind, it will be taxable. The Korean company had to pay tax on receipt of debenture of 2 crore as FTS. But this debenture has an interest as well. So the Korean company will receive an interest as well. So this interest shall also be taxable because it's an Indian company debenture. The money is used for in India only. This interest is also taxable in the hands of Korean company, and the Korean company has to pay tax on interest as well. So this was a small different point in this question. Therefore, I attempted this. So in the exam, 6 marks question, 2 marks for each thing. The student normally miss the third one, the interest part, because not being asked. So the offshore services, 3 crore taxable, chargeable tax in India. Onshore service, 2 crore, though not received as cash, received as kind in the form of debenture, but still taxable. Taxable in India. Interest, again taxable. Understood? Very small question. Let's complete this. It will take 2 minutes. Examine the tax consequence for assessment year 26-27 in respect of fee for technical service received by Mr. Tom Saver, a non-resident. So, non-resident receive FTS from Ganga Limited, an Indian company, in pursuance of agreement approved by the government. So, he has received FTS. It will be taxable under Section 115A. If India has no DTAA with country A, taxable at the rate of 20% under 115A. India has a DTAA with country A which provides for taxation or FTS at 55%. It shall be taxable at 5%, which is more beneficial. But in this case, the non-resident has to furnish the return of income. The exemption from return of income is available only if the FTS is tax deducted at the rate of 20%. India has a DTAA which provides for taxation of FTS at the 25%. Here also, the taxable at the 20% only, which is beneficial, and under Section 115A only. And therefore, benefit of exemption from filing return of income may be available. The technical service are utilized by Ganga Limited for his business in Kolkata. Okay. Assume that the non-resident is a resident of country A and he has no fixed place of profession. Okay. Would your answer change if he has fixed place of profession in India and he rendered technical service through that place? If he has a fixed place of profession, then 115A shall not apply. 44DA shall apply. The FTA shall be taxable on net basis after allowing the expenses. It shall be taxable at the rate applicable. If he's an individual, so slab rate. Okay. And he has to maintain books of account and get the books of account audited and furnish the return of income. Okay. Understood? Okay, friends. So this completes our class for today. Any doubt, do ask me. Otherwise, we'll meet in the next class. Thank you, Sanjay ji. Okay, signing off. Be happy. Wish you a happy new year again. Thank you. Bye. Yes, sir. Thank you.